everyone. Welcome back to Hari Academy CMA, where success is built on strong foundation. I'm Uday Kumar, and in today's session, we are diving into our FM MCQ series for CMA Inter Group 2. So, as I told you in our previous attempt, we brought you the double-headed MCQ series for Group 1, and this time we are enhancing your preparation for Group 2 as well. So, with the comprehensive coverage for Paper 9 OM and SM, Paper 10 Corporate Accounting and Auditing, which we have uploaded, and Paper 11, which will be done right now, FM and BDA. So on paper 12, management accounting as well. So if you are looking for MCQs across all papers, already I have told you. So they are available as a bundle for purchase on our website, Hari Academy CMA.graphy.com or through our app on the Play Store. So kindly check the description below for the links. So those all are available at a nominal cost. And please note that all the MCQs are on non-downloadable format. So it is nothing but view-only format. Okay. And one more thing, for those who have joined our live classes, this is going to be a perfect quick revision for FM. And if you haven't, please don't feel anything bad. So you can access our classes, recorded classes, which is on our website to cover every aspect in detail. So and feel free to ask any questions. So without any further delay, let's jump into the FM MCQs. Okay. So the question number 1, of the product of which two ratios is the return on investment composed? So return on investment composed, what does that mean? Which we have discussed in the ratio analysis part, right? So the return on investment, the formula usually, which is net profit divided by total assets, right? Just give me a second. Net profit divided by total assets. So here, easy one. Look, so net option A, overall turnover ratio and current ratio. So overall turnover ratio, which is considerable. Okay. So I'll tell you later. So easy it is. So current ratio, which will not be considered here. And there are net profit ratio and fixed assets turnover ratio, which is also not the right option, because here the fixed assets turnover ratio does not come under this return on investment, and as well as working capital turnover ratio and net profit ratio. So working capital turnover ratio also does not comes under this answer. So the final one, net profit ratio and overall turnover ratio. So the right answer is, which is net profit ratio as well as overall turnover ratio. So the reason, because overall turnover ratio, the formula which is sales divided by total assets, and whereas net profit ratio, net profit divided by sales. So usually here the return on investment is one of the key financial metric they used to say, right? So it helps in evaluating the profitability of an investment relative to its cost. So what I said, profitability of an investment relative to its cost. Okay, so this is because of net profit ratio and overall turnover ratio. If you combine both the things, it can be broken down as net profit divided by total sales, right? So here the net profit ratio, which is nothing but net profit divided by sales, and whereas overall turnover ratio, sales divided by total assets. So here, when you combine both the sales will get cancelled. Net profit divided by total assets, which is nothing but your return on investment, indicating how efficiently a company converts its sales into profits. Okay, and how well it utilizes its assets to generate the sales. Okay, so the right answer, which is net profit and turnover ratio. So moving to the question number 2, a firm determines the shareholders' wealth by taking option A, the number of people employed in the firm, the book value of the firm's assets less the book value of its liability, the amount of salary paid to its employee, the market price per share of the firm. So usually in reality, we will be considering the option which is option D, the market price per share of the firm. Whereas if you consider the textbook parts, so if you are considering the book valuation, balance sheet valuation or book valuation, you have to consider the option B. So generally, in general terms, we used to consider the market price per share of the firm. Okay. So if it is given balance sheet valuation or book value, then you must consider the option B. So moving to the question number 3, capital budgeting techniques. Okay. So try to answer each and every question. You guys have to participate. Okay. So capital budgeting techniques, which considers the time value of money, is based on. So based on what? It's quite easy, right? Based on cash flows of the organization, because so capital budgeting techniques that consider the time value of money are based on the cash flows of the organization. Because such as like take a look at NPV, internal rate of return, and discounted payback period, all focus on the inflows and outflows of cash over time. So here the time value of money concept implies that money available now is worth more than the same amount in the future because it can be invested and earned returns. So capital budgeting techniques discount the future cash flows to the present value to assess the profitability of long-term projects. Clear? So the cash flows are the correct focus. Clear? So cash flows of the organization is the right answer. Clear? So moving to the question number 4. Debt financing is a cheaper source of finance because of, what could be the answer? Debt financing is a cheaper source of finance because of tax deductibility of interest. Can you say the reason? Because debt financing is considered as a cheaper resource because interest payments made on debt are tax deductible, right? So interest payments made on debt are tax deductible, right? So that's one best reason, right? So it acts as a tax shield. So it's interest tax shield. Okay, this is known as interest tax shield. Okay, so the right answer which is tax deductibility of interest. So moving to the question number 5, what should be the optimum dividend payout ratio where R equal to 12% and K equal to 10%, which we have discussed in our dividend decisions. So you can try to recollect the answer, dividend payout ratio. So the right answer which is 0. Because in this scenario, R is equal to 12% and K is equal to 10%. R is equal to 12% and K is equal to 10%, right? So to determine the optimum dividend payout ratio, we need to compare the return on the we need to compare the return the company can generate, right? The return the company can generate by returning earnings to cost of equity capital. So there is some interpretations we have, propositions we have told you, right? If R is greater than KE, okay, so is in this case R is greater than KE? Yes, 12% is absolutely greater than 10%, right? So then the company should return all earnings. Just payout ratio is equal to 0%. Okay, so when the R is greater than KE, the company should return all earnings. Clear? So the right answer which is 0. A. Clear? So moving to the question number 6. The term float is used in float. We have discussed, right? The term float is used in which one? Cash management. Clear? Option B, cash management, because float refers to the period of time during which money is in transit between two parties. Okay? So in cash management, float represents the delay between the time when a check is written or a payment is initiated and the funds, when the funds are actually available in the recipient's account. So here the float, as I told you, float is included in the cash management. So there are two types of float. You can try to recollect. Collection float, disbursement float. Okay. So here the float is a key concept in cash management because it affects how a company manages its liquidity and available cash on hand. So the right answer which is cash management. Okay, so let's move into the question number 7. Which of the following would be consistent with a more aggressive approach to financing working capital? So here the option A, financing permanent inventory build up with long-term debt. Option B, financing short-term needs with short-term funds. The option C, financing some long-term needs with short-term funds. Option D, financing seasonal needs with short-term funds. What could be the right answer? I think you would have guessed the answer, right? So the option C is the financing some long-term needs with short-term needs is the aggressive approach of financing working capital. More aggressive, which would be like told. Okay. So here the aggressive approach to financing working capital refers to using more short-term financing even for long-term or permanent assets. It ultimately increases the risk, but may lower the financing cost due to the typically lower interest rates of short-term debts. Okay. So clear? Whereas other options like financing permanent inventory build up with long-term debt. So this is a conservative approach as it matches long-term financing with long-term needs, which is reducing the risk. There is no any aggression, right? And whereas come to the option B, financing short-term needs with short-term funds. It is moderate because balanced approach. So because it aligns the duration of funds with the duration of needs. So it is a moderate, okay? Whereas option D, financing seasonal needs with short-term funds. This is also a balanced approach. For temporary working capital, you are looking, right? So the aggressive, which is option C, right? Clear? So moving to the question number 8. Profitability and liquidity ratios are used for. Come on. Try to give the answer. Profitability and liquidity ratios are used for what? Both normative and predictive purpose. So profitability and liquidity ratios are used for both normative and predictive purpose, because they provide insights into a company's current financial health and help in forecasting future performance. So here the normative purpose, which is nothing but the ratios help assessing how well a company is performing related to industry standards, benchmarks, okay, or internal targets, okay. And whereas predictive purpose, these ratios are also used to predict the future financial outcomes, such as a company's ability to meet the future obligations to or generate profit. So the profitability ratios like the net profit margin and return on assets help in forecasting the potential growth returns to shareholders, okay, and the company's financial stability in the future. So here the answer would be both normative and predictive purposes. Clear? Moving to the question number 9. Okay, so the internal rate of return is the discounting factor of which? You must answer the question. It's quite easy. So internal rate of return is the discounting factor which? Option A, option B, option C, or option D? So absolutely the option would be option D. Equates the present value of net cash inflow to the net cash outflow, right? So the reason is internal rate of return is the discount rate that makes the net present value of all cash flows from a project or investment equal to zero, right? We have discussed in our regular classes, right? So in other words, it is a rate at which the present value of the net cash inflows equals the present value of the net cash outflows, right? So, and usually the IRR is used in the capital budgeting to evaluate the what? Profitability of an investment or project. So if the IRR is greater than the required rate of return, which is nothing but cost of capital, the investment is considered worthwhile. So here the option D is the correct, because IRR is the rate that equates the present value of inflows to outflows, which means the NPV of the investment is zero at this rate. Clear? So option D is the right option. Okay, moving to the question number 10. The degree of operating leverage and degree of financial leverage of VIM Limited are 2 and 1.5 respectively. If the sale increases by 10%, what will be the percentage change in EPS? So it's quite easy. We have discussed in our leverage chapter. So you can take a few seconds, you can pause the video and you can calculate and you can check the answer. Okay. So it is quite easy. Percentage change in EPS, which is nothing but DOL into DFL into what? Into percentage change in sales. Okay. So what I told, percentage change in EPS equal to DOL, okay, into DFL into percentage change in sales. So these are the information which is given in the question here, right? So VM Limited are, so what is the DOL 2 into 1.5 into percentage change in sales 0.10, right? So the option would be, what could be the answer? The option which is D, 30% if we calculate. Okay. So moving to the question number 11. Okay. EBIT EPS chart is used for which of the following purpose? EBIT EPS chart is used for which of the following purpose? Option A, determining the price earning ratio, showing changes of EPS over time. Option C, getting EPS levels for varying levels of EBIT. Option D, impact of sales on EBIT. The right answer which is what? Getting EPS levels for varying levels of EBIT. Clear? So because the EBIT EPS chart is used to analyze how earnings before interest and taxes affect earnings per share under different financing conditions. Okay. So it ultimately helps in understanding what? How changes in EBIT influence the EPS at various levels of debt and equity financing. Clear? So moving to the question number 12. So question number 12. Corporate financing instruments which have an unlimited life, voting right, and right to receive dividends are known as corporate financing instruments again. It's quite easier. This is one of the simplest question I would say. So corporate financing instruments which have an unlimited life, voting right, and to receive dividends are known as what? It's quite easier. Equity shares, right? I need not tell you about this because these are all discussed in the sources of finance, right? So moving to the question number 13, UBI Limited has EBAT of rupees. How much? 1 lakh, right? The company makes use of debt and equity capital. The company has 10% debentures of rupees 4 lakh. If the company's equity capitalization rate is 15%, what will be the value of UBI Limited? He is asking what? Value of UBI Limited. So the value can be found by using the formula, which is EBAT minus interest divided by KE plus debt, right? EBAT minus interest divided by KE plus debt. So by using this formula, try to find out the answer. You can pause the video and you can calculate the answer. You can answer the question. Because how am I able to write this formula? Because we have discussed all these concepts in our regular recorded classes or regular live classes, and now it is available in recorder. Okay. So you can try to solve the problem by using this formula. So then ultimately you will get the answer, right? So 1 lakh minus 40,000 divided by 15 percentage, which is nothing but 60,000 divided by 50 percentage. Plus you additionally you have to add the debt, which is 4 lakh. So 60,000 divided by 50%, if you do, you will be getting what? 3 lakh, right? So 3 lakh plus 4 lakh, the option would be 7 lakh. Clear? So answer which is, sorry. As I told you, 1 lakh minus 40,000, which is 60,000. 60,000 divided by 15%, you will be getting 4 lakh. So 4 lakh plus 4 lakh, which is nothing but 8 lakh. Okay. And moving to the question number 14. ABI Limited has paid dividend of rupees 3 per share of rupees 10 each last year, and it is expected to grow at 10% next year. If the market price of the share is rupees 60, what will be the cost of equity? He is asking KE. It's quite easier for you to calculate because the formula for growth dividend KE is equal to what? D1 divided by P0 plus G, right? Use this formula and find out the answer immediately. So it's quite easier. You should not waste the time. So if you use this formula, the answer you will be getting is 15.50%. So moving to the question number 15. Objective of financial management in the introduction part we have discussed maximization of shareholders wealth. Yes. And moving to the question number 16, which of the following variables is not known in, he's asking negatively, okay, not in a positive manner. He's asking in a negative manner, okay, is not known in IRR. In IRR, which of the following variable is not known? What are those variables? Let's take a look. Initial cash flows, discount rate, terminal inflows, life of the project. Which variable is not known? Absolutely, because you have to find this rate, right? So option B is the right answer because initial cash flows will be given, terminal inflows will also be given, life of the project will also be available, right? So discount rate which will not be available. So here, moving to the question number 17, cost of capital refers to what? Cost of capital, we have discussed the other names, hurdle rate, cutoff rate, and required rate of return or minimum returns expected by the shareholders. So answer option C. And moving to the question number 18, working capital management involves financing and management of what? You must answer this question because these are one of the easiest questions, right? Working capital management involves financing and management of what? All current assets, right? So moving to the question number 19, all listed companies are required to prepare what? Statement of affairs, cash flow statement, fund flow statement. What is the right answer? You must answer all these questions. It's because these are the easiest questions from the theory part. So the answer which is we have discussed, right? Cash flow statement, right? Okay, moving to the question number 20. Ratio analysis can be used to study liquidity, turnover, profitability, etc. of a firm. What does debt equity ratio help to study? Debt equity ratio. So we have discussed all these things, right? Debt equity ratio. So debt equity ratio measures the proportion of a company's debt to its equity. And is a Key indicator of a company is solvency. Okay. Okay. So moving to the question number 21. Which of the following does not help to increase current ratio? So do you think issue of debentures to buy stock increases your current ratio? Or issue of debentures to pay creditors increases the current ratio? Or sale of investment to pay creditors? Or avail bank overdraft to buy machine? Which of them? So availing the bank overdraft to buy machine. Because bank overdraft is nothing but current liability, right? So it increases the current ratio. Clear? Because what is the formula for current ratio? You must recollect here all the things. So current ratio formula, what is that? You must try to answer current assets divided by current liabilities, right? Current assets divided by current liabilities. Okay. So if current liabilities increases, it ultimately increases the current ratio. Clear? So moving to the question number 22. Which of the following is not considered while preparing cash budget? Which of the following is not considered while preparing cash budget? He is saying. Which is option A, accrual principle. Option B, difference in capital and revenue items. Option C, conservation principle. Option D, all of the above. While preparing cash budget, these all things will not be considered. Accrual principle will be never considered, right? We have to only consider the cash items. Difference on capital and revenue items, which will not be considered, which is irrelevant, and conservation principle, which is purely irrelevant. So, because these all items will not be considered while preparing the cash budget, so the option D is the right option, which is the all of the above here, option D. Okay. So, moving to the question number 23, cost of capital may be defined as minimum rate of return that the firm should earn, average IR of the projects of the firm, weighted average cost of all debts, rate of return expected by equity shareholders, which is the right option. Minimum rate of return that the firm should earn, right? Okay. So moving to the question number 24, at indifference level, which we have discussed in our regular live classes, right? At an indifference level of EBIT, different capitals have what? You must answer all these questions. At indifference level of EBIT, different capitals have same EPS, because the indifference level of EBIT is the point at which the EPS is the same, regardless of the financing mix, which is nothing but debt or equity. It can be at this level of EBIT, different financing structures yield the same EPS. That's the reason it is said to be indifference point, right? Indifference point, right? So at this indifference level, different financing structure will have the same EPS, right? We have discussed. And moving to the question number 25, ABC analysis used in what? ABC analysis used in, definitely you would have learned this in costing to group 1 costing. ABC analysis used in inventory management, which is nothing but stock, raw material, or anything it can be, right? So moving to the question number 26, which of the following is not incorporated in capital budgeting? Tax effect, time value of money, required rate of return, rate of cash discount. Which one? Question number 26. We have seen this tax effect, time value of money required. What about this rate of cash discount? Nowhere we have, because it is not incorporated in the capital budgeting, right? So by using these elimination methods, okay, you have to find the answers. Okay, which of the following is a profitability ratio? Question number 27. Which of the following is a profitability ratio? You must answer this question. Price earning ratio is the profitability ratio, right? So price earning ratio, what does it mean? Price earning ratio is a profitability ratio because it measures the relationship between a company's market price per share and its earnings per share, right? What does it measure? It measures the relationship between a company's market price per share as well as the earnings price per share. And it reflects the how much investors are willing to pay per rupees of earnings. What I said? It reflects how much investors are willing to pay per rupees of earnings, which ultimately indicates the market expectations of a company's profitability and growth, right? And whereas proprietary ratio is a solvency ratio, debt equity ratio is a leverage ratio, fixed asset ratio is a type of asset management or turnover ratio, right? Whereas profitability ratio is price earning ratio. Clear? So option C is the right option. So moving to the question number 29. Which of the following is not a source of fund? Source of fund. Issue of capital is a source of fund. Issue of debenture is a source of fund. Decreasing working capital and increasing working capital, which is not a source of fund. Come on. Decreasing or increasing? Increasing in working capital is not a source of fund. Can anyone say what is the reason behind increasing working capital is not considered as source of fund? It's quite easy. So source of funds refers to, first you need to have a knowledge regarding what does it mean the source of funds. So here the source of fund refers to any method or activity that generates cash inflows for a business. Right? What I told? Cash inflows for a business. So whereas take a look at issue of capital. So this is a source of funds as it generates cash for the company through the sale of equity. And whereas the issue of debenture, this also represents a source of funds. Since it raises capital through debt financing. And moving to the decrease in working capital. A decrease in working capital implies that current liabilities have increased. Okay, related to current assets. What I told? Current liabilities have increased. You might think decreasing working capital could be the answer, but what I told, decreasing working capital, what does that mean? Current assets minus current liabilities. So if it is decreasing, then it's nothing but current liabilities have increased related to its current assets. So freeing up cash and effectively acting as a source of funds. So ultimately the answer could be increasing working capital indicates that a company is using funds rather than generating them. That's not serving as a source of funds. So option D is the right answer. Okay. So moving to the question number 29. Beta of a security measures. We would have capital asset pricing model. Are you guys able to answer CAPM approach? We have discussed, right? Try to answer beta. What? Beta is a market risk. Okay, already we have discussed, right? So moving to the question number 30. The following is not a discounted cash flow technique. The following is not a discounted cash flow technique. NPV is a discounted cash flow technique. PA, profitability index, accounting of average rate of return. IRR is also a discounted cash flow technique. So in this manner, you can eliminate the options. So profitability index is also a discounted cash flow technique. And whereas accounting of average rate of return does not include any discounted cash flow technique. Okay. So discounted cash flow techniques are methods used to evaluate the profitability of an investment by taking into account the time value of money. Okay. So here the NPV, PA, IRR, all these techniques includes time value of money. But whereas accounting of average rate of return, it does not consider the time value of money. And instead just calculates the return based on the average profits. Okay. So option C is the right answer. So moving to the question number 31, the dividend payout ratio is equal to, come on. Option A, dividend yield plus the capital gains yield. Option B, dividend per share divided by earnings per equity share. Option C, dividends per share divided by par value per share. And option D, dividends per share divided by current price per share. Which is the right answer? Come on. Which is the right answer? Option B, dividend payout ratio. Dividend per share divided by earnings per equity share. Because dividend payout ratio is as I told you, which we have discussed everything in the dividend decision, right? It's also a key financial metric we used to say. So what does it function? So it indicates the proportion of earnings that a company distributes to its shareholders in the form of dividends, as I told. So it is calculated. What using the formula dividend payout ratio is equal to dividend per share. How much dividend you are issuing from your earnings, which is nothing but earnings per share. So if you are earning 5 rupees, from the 5 rupees, how much you are issuing as a dividend? If you are issuing 2.5 as a dividend, which is nothing but dividend payout ratio 50%, right? Clear? So the option which is B. So moving to the question number 32. If EBIT is equal to 1 lakh, fixed assets equal to rupees 2 lakh, sales is equal to rupees 10 lakh and variable cost 7 lakh, then the operating leverage. So here you must recollect the operating leverage formula. Contribution divided by EBIT. So here the contribution, again, what does it mean? Sales minus variable cost. What is the value of sales? 10 lakhs minus variable cost 7 lakhs, which is nothing but contribution 3 lakhs. 3 lakhs divided by EBIT, which is 1 lakh. So then, what is it? 3. Value. Operating leverage will be 3. Option B. So moving to the question number 33. Which one of the following activities outside the purview of dividend decision in financial management? You must try to answer these questions. So these are the theory type of questions. You must be able to answer these questions because easily you can score 2 marks. Okay. So again, I'll read the question. Which one of the following activities outside the purview of dividend decision in financial management? Identification of the profit after tax is inside the purview, right? And measurement of the cost of funds. So cost of funds, where it comes from? Okay. So in financial management, the dividend decisions focuses on determining how much profit to be distributed to shareholders as dividends versus how much to retain in the business for reinvestment. This is what we have discussed, right? So, so the activities associated with these decisions includes identification of the profit after taxes. And option C, take a look at option C, deciding on the payout ratio, which is also included. And option D, considering the issue of bonus shares to equity shareholders. This is also included, right, in the purview of dividend decision. And whereas option D, measurement of the cost of the funds, is more related to financing decisions and does not fall under dividend decisions activity. So it focuses on the costs associated with raising capital, which is separate from how profits are distributed. So option B is the right answer here. Clear? So moving to the question number 34. Which of the following statements is correct? Option A, a higher receivable turnover is not desirable. Option B, interest coverage ratio depends upon tax rate. Option C, increase in net profit ratio means increase in sales. Option D, lower debt to equity ratio means lower financial risk. Which option is the right option? So option D, because take a look at option A. A higher receivable turnover ratio is not desirable, it is told, right? So what could be the reason? Because option A is incorrect, purely incorrect, because a higher receivable turnover ratio indicates that a company is effectively managing its receivables and collecting its debts more quickly, which is generally desirable, right? How can we call it as not desirable? So option A is incorrect, right? So moving to the option B, interest coverage ratio depends upon tax rate. How come? This is purely misleading, right? While taxes affect net income, the interest coverage ratio itself is calculated using EBIT and it does not indirectly depend on the tax rate, right? So it assesses a company's ability to meet its interest obligation regardless of tax considerations, right? So it's purely misleading. So even option B is incorrect. So moving to C, option C, increase in net profit ratio means increase in sales. So in all scenarios, it need not be like correct. Okay, it is not necessarily correct, I would say. So an increase in the net profit ratio indicates that the company is either increasing profits related to its sales, or we can say it as reducing cost also even, right? So you need not only increase the sales, you might reduce the cost too. Then how it will be like the right option, right? So it doesn't directly imply the sales have increased. Okay. So move to the option D. Lower debt equity ratio means lower financial risk. Isn't that right? Absolutely, this statement is correct because a lower debt equity ratio indicates that company is relying less on debt financing compared to equity financing. So which generally reduces its financial risk, right? So financial risk is associated with what? Interest. So interest is associated where when you are availing debt, you must pay the fixed obligation, which is nothing but debt. So there arises financial risk. So if the debt equity ratio is lower, then ultimately the financial risk also gets lower, right? So the option D is the right option. So moving to the question number 35. Shareholders' wealth in a firm is reflected by. Shareholders' wealth in a firm is reflected by the market price of the per share of the firm, right? Moving to the question number 36. The excess of current assets over current liability is called. Excess of current assets over current liability is called. What you would say? Net current assets? Or should be net working capital? Or working capital, all of them? Yes, it's absolutely all of them. Clear? So moving to the question number 37. Which of the following is the main objective of financial management? Revenue maximization, profit maximization, wealth maximization, cost minimization. Which is the right option? Absolutely, we know that the profit maximization or wealth maximization, right? So moving to the question number 38. Which one of the following activities is outside the purview of the financing decision? Earlier we discussed outside the purview of dividend decision. Now it is financing decision in financial management. So option A, identification of the source of funds, measurements of the cost of funds, designing on the time of raising the funds, designing on the utilization of funds. How come? So option A, B, C, all these three options are, I think it's relevant. But whereas option D, utilization of funds is related to the investment decisions, right? How come then? So option D is the outside the purview of the financing decisions. Clear? So moving to the question number 39. A firm has a capital of rupees 10 lakhs, sales of rupees 5 lakhs, gross profit of rupees 2 lakhs, and expenses of rupees 1 lakh. The net profit ratio, it's quite easier. You have to recollect net profit ratio. Gross profit, first you have to calculate the net, in order to find out the net profit ratio. Net profit ratio is nothing but net profit divided by sales, as you know that. So first you need to calculate the net profit, which is nothing but what you would do? Sales, sorry, what you would do? Gross profit minus expenses, right? Gross profit minus expenses is nothing but net profit. So first you have to arrive at what? Gross profit. So here in the question, look for the gross profit. It is given 2 lakhs minus expenses 1 lakh. So the net profit would be 1 lakh, right? So 1 lakh divided by 5 lakh, which is nothing but 20%. Clear? So moving to the question number 40. Which of the following forms of equity financing is especially designed for funding high risk and high reward projects? Which of the following forms of equity financing is especially designed for funding high risk and high reward projects? Option A, ADR. Option B, GDR. Option C, FCCB. Option D, venture capital. If you would have like go through with the theory parts, then it would be quite easy for you to answer. So option D, venture capital, because ADR is nothing but American Depository Receipt. Okay, so it is a way for US investors to invest in foreign companies, right? So ADRs represent shares in foreign companies and are used primarily for attracting foreign investments, not specifically for high risk projects. Whereas option B, GDR, Global Depository Receipt. So it is also similar to ADRs, which are used to raise capital in foreign markets. Okay, but they are not specifically targeted at high risk projects. So whereas option C, FCCB, which is nothing but foreign currency convertible bonds. So these are the bonds that are that can be converted into equity at a later date. Okay, so typically issued by companies looking to attract foreign investment. Okay, so they are not exclusively designed for high risk endeavors. Whereas venture capital, come to the venture capital, you would have like heard this word even in the movies. Okay, so venture capital, this is a form of equity financing specifically aimed at startups and early stage companies. So in both the startups and the early stage companies, there will be a high growth potential as well as high risk. Okay, so venture capital is provide funding in exchange for equity and often invest in high risk, high reward projects. Okay, so the option D is the right answer. Clear? So moving to the question number 41. A process through which loans and other receivables are underwritten and sold in a form of asset is known as what? Securitization, right? So these are the theory questions which may come in your exams. So please concentrate on our video. So, okay. So the answer is securitization, because here you will be learning all the wordings called factoring. So let's know about the term called, which is factoring. So factoring, it involves selling accounts receivable to a third party. What I told, factoring. So if you are having the data, which is nothing but accounts receivable, if you are sending them for the collection to a third party and making the third party to make the collection, so which is nothing but factoring. And whereas forfeiting, so it is also similar to factoring. Okay, but typically it involves the sale of long-term receivables or export receivables. What I told? Long-term receivables or export receivables. Here it is just accounts receivable factoring. Long-term or export receivable is forfeiting. And whereas securitization is the process of pooling various types of contractual debts like loans and receivables. Okay, and selling them as a consolidated financial instruments known as asset-backed securities, ABS we used to say. So this process transforms liquid assets into liquid securities that can be sold to investors, effectively creating an asset. Okay, securitization. Whereas bill discounting, so this involves selling bills of exchange at a discount to a bank or financial institution before their maturity date. Okay. For what purpose? To obtain the immediate funds. So here the option C is a securitization. Because a process through which loans and other receivables are underwritten and sold in a form of asset. Okay. So moving to the question number 42. In net profit ratio, the denominator is what? Credit sales, net sales, cost of sales, cost of goods sold. Here, if it is given as sales, you would have answered the question. But now you must, nothing but credit sales alone would you take? No. Cost of sales would you take? No. Cost of goods sold? No. Then the option which is net sales. So moving to the question number 43. If the fixed cost of production is zero, which one of the following is correct? Operating leverage is zero, financial leverage is zero, combined leverage is zero, none of the above. Simple. Fixed cost, where it arises. Come on, try to answer the question. What is the answer? One. So the answer which is none of the above, you must think. You must think again one more time. Operating. So few people may think, so none of the above. Few may say it as operating leverage. Which one? Operating leverage is zero, right? So because of fixed operating cost only, it arises operating leverage, right? Right? Operating leverage arises because of fixed operating cost. If there is no any fixed production cost, how it will be? So then the operating leverage is zero. Okay. When the fixed cost of production is zero. Clear? So moving to the question number 44. The degree of operating leverage and the degree of financial leverage of Atlanta Limited are 3 and 1.6 respectively. If the management of the company targets to increase the EPS by 10%, by how much percentage should sales volume should be increased? So, okay, he is saying to round off your answer to the nearest value. So he have given the operating leverage and financial leverage, and company targets to increase the EPS by 10%. So they are willing to increase their EPS by 10%, and then now they are asking to calculate the how much percentage should sales volume be increased. So it's quite easy. Percentage increase in EPS equal to what? Percentage increase in EPS. It is equal to DOL into percentage increase in sales. Okay. Percentage increase in EPS, how much it is? 0.10 or 10% we can say it as. Equal to DOL, how much it is? 3 into percentage increase in sales. Now it's quite easy to calculate. Then if you do the calculation, 10% equal to 3 into, let's consider the percentage change in increase in sales is X. So if you consider take X in the left hand side, then right hand side 10% divided by 3, which is nothing but 3.3333%. Then your answer would be 3.4. You can consider 3.3 percentage. Sorry, 3%. You can consider it. Okay. So moving to the question number 45. Average collection period is 2 months. Cash sales and average receivables are 5 lakh and 6 lakh 50,000 respectively. The sales amount would be, average collection period is 2 months. Okay. And cash sales and cash receivables are 5 lakh and rupees 6 lakh 50,000 respectively. The sales amount would be, it's quite easier. You must recollect all the formulas. So here you have to calculate sales. What is asking to compute? Total sales. So total sales is nothing but credit sales plus cash sales. So first you need to calculate what sales we have made. So in order to calculate the sales, you must be able to arrive at what? Receivables turnover ratio. Okay. So here in the question, we are the data which is given is average collection period 2 months, which is nothing but ACP, average collection period. Cash sales 5 lakh, it is already given. Average receivable 6 lakh 50. So by using the receivable turnover ratio formula, which is nothing but sales divided by average receivables, 12. Okay, right? So sales divided by average collection period. So 12 divided by 2. Okay. So 12 divided by 2, which is nothing but 6. Okay. So 6 into 6 lakh 50,000. Receivable turnover ratio into average receivables, 39 lakhs. 39 lakh plus 5 lakh, which is 44 lakhs. Okay. So moving to the question number 46. Conversion of marketable securities into cash entails a fixed cost of rupees 1000 per transaction. What will be the optimal conversion size as per Baumol model of cash management? We have discussed the Baumol model of cash management, right? In which we have discussed. It's quite easy. C is equal to 2ds divided by I. It's as like your 2AO divided by C, right? So if you implement the values in the formula, okay? So fixed cost, which is being 1000, okay? And let's assume that the demand is 1 lakh, okay? 1 lakh rupees. And the assumed interest rate, let's take it as 5%. Just calculate. You'll be getting the answer, which is 2 lakh. Clear? So just give me a second. Calculate, you will get the answer, which is as per Baumann model, the answer right option, which is 3,16,228. Okay. So moving to the question number 47. What is the value of levered firm L Limited if it has the same EBIT as an unlevered firm U Limited with value of rupees 700 lakh, has a debt of rupees 200 lakh, tax rate is 35% under approach. He is asking under which approach? Under approach. Clear? So you must be able to answer all these questions. So it's quite easy, I would say. Okay, the data given already, the data is already given in the question, which is EBIT, same EBIT for levered as well as unlevered, it's a value of rupees 700 lakh, right? So VU on VU of the value of levered from and unlevered from both are same, right? So first you have to calculate tax shield from debt. This is nothing but 0.35 into 200, you will be getting 70 lakhs. And value of levered firm. Levered firm, which is unlevered firm, you will be like having, you have to add the tax benefit. Okay. Which is nothing but 700 plus 70, you will be getting 770 lakh. Because I would like to list them all here. If you do, you will get 70 lakhs. And thereafter, value of levered firm is equal to value of unlevered firm, he told, right? So which is nothing but plus T into D. So it is 700, it is 700. Again, if you add, you will be getting 770 lakh under MM. So moving to the question number 48. Initial investment of rupees 20 lakh. Expected annual cash flow rupees 6 lakh for 10 years. Cost of capital 15%. Profitability index is cumulative discounting factor at 15% for 10 years, which we have given is 5.019. So now you have to simply calculate the profitability index. What is the formula? Present value of cash inflows divided by initial investment. Clear? Present value of cash inflows divided by initial investment. So first thing you have to calculate the present value of cash inflows, which is nothing but annual cash flows into cumulative discounting factor. So what is the annual cash inflows? 6 lakhs into 5.019. You will be getting 30.114 lakhs, right? So thereafter, so if you divide it by 20 lakh, then you will be getting the answer 1.5 something, right? So the option A is the right option. Okay, clear? So moving to the question number 49. Capital budgeting deals with long-term decisions, short-term decisions, both A and B. Absolutely, long-term decisions. We need not like even negotiate regarding this. So moving to the question number 50. So 5 years ago, KPM Limited issued 12% irredeemable debentures at rupees 105. Rupees 5 premium to their par value of rupees 100. The current market price of this debenture is rupees 95. If the company pays a corporate tax at a rate of 35%, what is the current cost of debenture capital? It's quite easy. Please try to recollect the debentures formulas, right? Irredeemable debentures. Interest into 1 minus tax divided by net proceeds are market price. So what is the value? Interest, which is nothing but 12% of rupees 100, which is 12, right? 1 minus tax, which is nothing but 0.35 you will be getting. Divided by market price, current market price 95. If you calculate, then you will be getting the value which is after inter-tax payment. If you do that, you will be getting 7.8. 12 into, 1 minus 0.35, right? 1 minus 0.35, then you will be getting 12 into 1 minus 0.35 divided by 95, which is nothing but 12 into 0.65 divided by 95, which is equal to 7.8 divided by 95. Then you will be getting, what's the value? Definitely 8.21 percentage. So option C is the right option. Clear? So still we have left with 150 questions. We'll complete it as soon as possible. Okay. So just stay on. Just keep watching the video. Okay. Number 51. In case the firm is all equity financed, the weighted average cost of capital would be equal to. It's a quite easy question. One of the most easiest question. Okay. So it's easy, right? So in the case when a firm is entirely equity financed, there is no debt component, right? So therefore, the weighted average cost of capital would consist solely of the cost of equity. So since weighted average cost of capital is the average cost of all financing sources weighted by the respective proportions, which we used to say weights, right? And all equity firms, weighted average cost of capital is simply its what? Cost of equity. As there is no any other debt component, as I told you, there is no any debentures or preferential capital or any other term loans, right? So the only sole financing which we have used is equity. So then the weighted average cost of capital will be ultimately the cost of equity, right? So question number 51, the answer which is B. Okay, move to the question number 52. Dew point analysis. It's quite easy, right? So dew point analysis. So it is one of the financial assessment framework, right? So that breaks down a company's return on equity, which is nothing but return on equity into three components. Let's say that it's a thing which is given, right? So return on equity into three components, which is nothing but profitability, asset efficiency, and financial leverage. So here the profitability is which is nothing but measured by net profit margin, and as well as asset efficiency is measured by the asset turnover, and whereas financial leverage measured by the equity multiplier. So actually this dew point analysis helps in understanding the drivers of ROE. So how the return on equity is like increasing or decreasing? What are the factors which are driving the return on equity? So by examining how well the company is managing its profitability, asset utilization, and leverage, which is nothing but the answer, which is option E, analysis of current assets, no. Analysis of profit, is it's relevant. Capital budgeting, no. Analysis of fixed assets, no. So the answer which is analysis of profit. Moving to the question number 53. XYZ Limited has earned 8% return on total assets of rupees 50 lakhs and has a net profit ratio of 5%. Find out the sales of the firm. He's asking us to find out the sales. The information which are given in the question are 8% return on total assets. So return on assets, ROE is equal to 8%, and ROE formula which is net profit divided by what? Total assets, right? So here you have to 8% equal to net profit. We have to find it out, right? Divided by total assets, 50 lakhs. So you can easily calculate the net profit, which is 850 lakhs into 8%, which is nothing but 4 lakh. So by using the formula again, so net profit ratio, right? With the, as in the question it is given, net profit ratio is given, right? So net profit ratio is equal to net profit divided by sales. So net profit ratio which is given, how much? 5% is equal to net profit divided by sales, right? So 5% is equal to net profit, which is 4 lakh divided by sales. You have to take this sales this side. Sales equal to 4 lakh divided by 5%, which is nothing but. So if you do by using a calculator, 4 lakh divided by 5%, the answer which would be 80 lakhs, right? So option C is the right answer. So moving to the question number 54, relationship between annual effective rate of interest and annual nominal rate of interest is if frequency of compounding is more than 1. So these type of questions which we have discussed in our live sessions, right? So it's quite easy. You can easily answer the question. Option A, effective rate is less than nominal rate. Option B, effective rate is greater than nominal rate. Option C, effective rate is equal to nominal rate. Option D, none of the above. So the students, those who have watched our live classes and recorded classes, they can easily answer the question because option B is the right option. Effective rate is always greater than the nominal rate. So when the frequency of compounding is more than like 1, whereas like semi-annually or quarterly or monthly, the annual effective rate will be greater than the annual nominal rate, right? So this is because compounding more frequently increases the amount of interest earned or paid over the course of the year, right? So option B is the right option. So moving to the question number 55, efficient portfolios are those portfolios which offer dash, in bracket is given that for a given level of risk. Efficient portfolios are those portfolios which offer what? Ultimately, efficient portfolio in the sense, those portfolios which offer maximum return. Because efficient portfolios are part of the efficient front end, okay, where they maximize expected return for a specific level of risk. Sorry, specified level of risk, right? So, alternatively, like minimize risk for a given expected return. You could say that. So, this concept is fundamental in modern portfolio theory. Okay. So moving to the question number 56, what is the value of a levered firm L Limited if it has the same EBIT as an unlevered firm U Limited? So with the value of rupees 700 lakh and has a debt of rupees 200 lakh, tax rate is 35% under approach, which is nothing but Modigliani-Miller approach. So what are the information which are given in the question? What is the he's asking us to find out what is the value of the levered firm. Value of levered firm is equal to value of unlevered firm plus debt into tax rate. As per Modigliani-Miller approach, this is the formula which we have learned, right? We have discussed regarding this, right? So if you apply the values in these formulas, you can easily find out the answer. So you can just VL, which is nothing but value of the levered firm, VU, which is nothing but value of the unlevered firm, D is the debt, T is the tax rate. So already, which is given, value of unlevered firm is given 700 lakh plus debt, which is 200 lakh. So the tax rate, which is also given 35%. So if you just put the values in those formulas, you can easily get the answer. 200 into 0.35, which is nothing but 70 lakhs. And already the value of unlevered firm is 700 lakhs. So the overall value of the levered firm, which will become 770 lakhs. It's quite easy. You just implement the values here. 700 plus 200 into 35 percentage. So 200 into 35 percentage, using your calculator, you can easily calculate it. So 70 plus 700, which is nothing but 700 in 70 lakhs value of levered firm. So option A is the right answer. Moving to the question number 57, X Limited distributes its product to more than 500 retailers. The company's collection period is 30 days and it keeps its inventory for 20 days. The operating cycle would be, what's the answer? Operating cycle is asking us to calculate, right? So operating cycle is nothing but is equal to inventory period plus receivables period, right? Well, just give me a second. I hope now it's visible, right? So inventory period is equal to, sorry, operating cycle, let's say OC, okay, is equal to inventory period plus receivables period. Clear? So operating cycle, which is equal to inventory period plus receivables period. Okay. So in the question which is given, inventory period 20 days, receivables period, which is nothing but collection period, is 30 days. So the operating cycle, which is 20 plus 30 days, right? So then the answer would be 20 plus 30, which is nothing but 50 days. Clear? So moving to the question 58, higher FL is related the use of higher FL. What does it mean? Higher FL, financial leverage. So higher financial leverage is related to the use of what? Which is one? Refers to the use of debt to finance the company's operations or investments. So a higher FL indicates what? That a company is using more debt related to equity. So which amplifies both potential returns and risk. So the correct answer is higher debt. Okay. So moving to the question number 59. According to Gordon's dividend capitalization model, if the price of a firm is rupees 43, its dividend payout ratio is 60%, cost of equity is 9%, ROI is 12%, and the number of shares are 12,000. What will be the net profit of the firm? So it's quite lengthy on. Okay. So P is equal to D divided by K minus G. Just implement the values here. Okay. So that before that, you have to find out the G, growth rate. Okay. So growth rate, return on investment into retention ratio. This is all we have discussed. Okay. So if you, the growth rate will be, which is ultimately 12% into 0. Retention ratio, which is given, which is nowhere given. So then we have to calculate. So retention ratio is equal to 1 minus dividend payout ratio, right? So if you substitute the values in the formula, 1 minus dividend payout ratio, 1 minus which is nothing but 60%, the retention ratio will be 40%. So if you are issuing the dividend as for 60%, the remaining portion which is retention, right? So retention ratio which is nothing but 40%. So here return on investment into retention ratio which is nothing but 40%. If you do that, so you will get the value which is nothing but G is equal to 4.8% is the growth rate. So you can implement the value here, and the KE is more given here, cost of equity 9%, and the dividend is also given, right? So, okay. So if you substitute the values over there, you can easily calculate. So calculate the dividend per share. Here we have to calculate the dividend even, right? So dividend is equal to, again, so simple. P into KE minus G as the market price of the share is given. So if you just substitute the values 43 into 0.09 minus 0.048, okay, then you will get 43. Then if you substitute the values 43 into 0.042, which is nothing but 1.806, you will get dividend. So now you just multiply the dividend per share into number of shares, you will get the answer. Total dividend you will get, right? So just nothing but if I just substitute the values 1.806, which I got the dividend value, as I told you, first thing which is given, first we have to calculate the growth. Okay, just nothing but ROI into retention ratio. Here in the question, nowhere the retention ratio is given. So, but ultimately you can easily find it out because the dividend payout ratio is 60%. So the remaining portion, which is nothing but retention ratio, right? So if there is a 1 rupee dividend, sorry, 1 rupees earning per share, from which they are issuing 60% dividend, which is nothing but dividend payout ratio is 60%, then 0.6 paisa is a dividend. What about the remaining portion, 0.4 paisa, that is said to be a retention, right? So out of 1 rupee, 6 paisa is dividend and 40 paisa is the retention. Okay. So if you are giving 60% as the dividend payout ratio, what about the remaining 40%? That is said to be a retention, right? So as I told you, in order to find the growth, return on investment into retention ratio. So here the return on investment which is given 12% into, if you substitute the value 0.40, then the G which you will be finding the answer which is 4.8%. So now we have to find out the value which is dividend per share. So then only you can ultimately multiply with the number of shares, then you can attain the value which is the total amount of dividend, right? So before that you have to find out the dividend per share value. So which is equal to, you can easily by using the Gordon's growth model formula. So which is given here, P is equal to D divided by K minus G, right? So you can easily calculate. So keep the dividend here and just send this denominator value to the left hand side. Then ultimately D is equal to P into KE minus G. So if you substitute the values, so P which is given 43 into K which is given 0.09 minus 0.048 is equal to D. Then the dividend per share you will be getting as 1.806. So if you multiply this 1.806 with the number of shares, then you will get the total value of dividend. Okay, 1.806 with 12,000, you will get the value which is 21,672. Please kindly use your calculator while solving the problems. So, okay. So now easily you can find out the net profit. So total dividend which is paid is 21,672, which is the 60% of the total earnings, right? So what they have said, 60% of the total earnings is dividend distributed as dividend. So if 60% of the earnings per share is 21,672, then what about the 100%? So you have to do 21,672 divided by 60%. If you do 36,120 rupees is the net profit of the firm, in which 60% is paid as a dividend. Now just from the 36,120, just do 36,120 into 60%. 21,672 is distributed as dividend. Then your answer is absolutely right. So option C is the right option. Okay, moving to the question number 16. A sound capital budgeting technique is based on. A sound capital budgeting technique is based on what? So capital budget. So from the option, you can just eliminate the remaining portion, right? First thing, cash flow. Yes, it's highly relevant, I would say. Accounting profit. Nowhere we have discussed regarding the accounting profit while computing the capital, while solving the capital budgeting problems, right? And interest rate on borrowings. Where did we discuss interest rate on borrowings? Is it any cost of capital? No, right? So last dividend paid. Nowhere it's relevant. So the only thing which is relevant is cash flows, right? So by using the elimination method also, you can eliminate the remaining options and you can select the right option. Okay. So moving to the question number 61, which of the following is not true with reference capital budgeting? So you have to now more focus on the options. So there will be like, everything will be like familiar or similar, we can say. So option A, capital budgeting is related to asset replacement decisions. Cost of capital is equal to minimum required return. So there are existing investment in a project is not treated as sunk cost. Timing of cash flow is relevant. So easily you can answer. What is the right answer? So it's quite easy. Existing investment in a project is not treated as sunk cost. Where did we discuss regarding this? So it's not true with the reference capital budgeting. Clear? So moving to the question number 62, minimum rate of return that a firm must earn in order to satisfy its investor is also known as minimum rate of return that a firm must earn in order to satisfy its investors. Who are they? They might be like equity shareholders, preference shareholders, debenture holders, anyone. It can be a bank, those who have provided the term loan. So it's also known as what? Which we have discussed already, weighted average cost of capital. Don't waste your time in the silly questions. Just if you have seen the question and if you are getting the relevant answer in the options, just fix it off. Okay. So moving to the question number 63, short selling refers to, what does it mean? Short sellings, buying shares are and then selling them on the same day. No. Selling shares without owning them. Selling shares out of a large holding. Continuously selling shares in a lot, which is the right option. So selling shares without owning them is the right option. Because even you would have seen in the movies, as I being FM students, you would have seen in like stock market and all, right? So short, sorry to say that. So short selling refers to the selling shares without owning them. That is a short selling shares, short selling, right? So short selling is a like if you want to discuss in a detail, is a practice of selling shares that an investor does not currently own, typically by borrowing them with the intention of buying them back later at a lower price. So okay, so the goal here is to make profit from a declining stock price. Okay, so after selling the borrowed shares, so here the investor plans to repurchase them at a lower price. That's what the short selling. Okay. So moving to the question number 64, net profit ratio signifies operational profitability, liquidity position, victim solvency, profit for lenders. What does it mean? Yes, operational profitability. So liquidity position, will you be considering the net profit ratio? There is nowhere it's relevant to the liquidity position. Victim solvency, nowhere. Profit for lender, not at all. Do they look at the net profit ratio? Profit lenders? No. So moving to the question number 65, in inventory turnover calculation, what is taken in the numerator? In inventory turnover, think. So that's the reason you must be clear about ratio analysis. We have discussed in detail in our recorded classes, or sorry, in our live classes. So okay, so inventory turnover ratio calculation, what is taken in the numerator? Absolutely, COGS divided by average inventory, which is nothing but cost of goods sold, right? So moving to the question number 66. If annual effective rate of interest is 10.25% per annum and nominal rate of return is 10% per annum, what is the frequency of compounding? We have discussed in our live classes, right? So it's option C 2. So operating cycle is also called as So while discussing the chapter, we have discussed in detail again. Just working capital cycle is also known as operating cycle. Okay. So business cycle, nowhere it is relevant, right? Business cycle, the features are like the phases are like a trough, peak. Those are not considered here, right? Working cycle, nowhere we are discussed. Current asset cycle. So which means you won't consider the current liabilities, huh? No, we haven't discussed like that, right? So working capital cycle is also called as operating cycle. So you must be clear with this. So moving to the question number 68, the following information is given for a project. Annual cash inflow, which is 8 lakh, useful life 4 years, payback period 2.855 years. Okay, the cost of the project would be. So you must be clear about why. Whenever like you go through with the concept, just make a summary chart so that you can easily analyze it. So or you can easily revise before your exams. So you can easily find out the cost of project. How it's possible? Annual cash inflows into payback period. Simple. So here already the annual cash flow which is given 8 lakhs and the payback period which is 2.855. If you multiply both the values, you will get the value which is just multiply. So you'll easily get the value which is 22 lakh 84,000. I think I'm right? So it's quite easy. 22 lakh 84,000. So moving to the question number 16, a proposal is not a capital budgeting proposal if it is related to fixed assets. Okay, it's the right option. So brings long-term benefits, brings short-term benefits only, has very large investment. So it's more than enough. Short-term word is nowhere used in the capital budgeting. So just this is the right option because a proposal is not a capital budgeting proposal if it brings short-term benefits only. Clear? So moving to the question number 70, advantage of debt financing is obviously no need to discuss. Like look for the options. So there is an option called all of the above. Then you must be careful. Okay. So there could be a chance for all of the above. Okay. So you have to look the options very carefully. Interest is tax deductible. Yes, it's true. It reduces weighted average cost of capital. It's true. It does not dilute owner's control. Yes, it's absolutely true. Right. So the option D, all of the above is the right option. Moving to the question number 71. ABC Limited has a current ratio of 1.5 is to 1 and net current assets of rupees 5 lakh. What are the current assets? So we have given the values for us. So I'll just provide you the formula so that you can easily answer the question. Clear? So what is the current ratio formula? Current ratio formula. Sorry. Current ratio formula. Current assets divided by current liabilities. So current ratio which is given is 1.5 is to 1. Clear? 1.5 is to 1. And what are the remaining things given here? Net current assets which is given 5 lakh. So net current assets is nothing but current assets minus current liabilities, right? So which is current assets divided by current liabilities equal to 1.5. Clear? So then ultimately current assets is equal to 1.5 current liability. Clear? So if you just substitute the values, current assets minus current liability, which is equal to 5 lakh. Now substitute the values of net current assets. Okay. So net current assets, if you substitute the value, okay, you can easily get the values 1.5 CL minus CL is equal to 5 lakh. So if you 0.5 CL divided is equal to 5L. CL is equal to 5L divided by 0.5. You can easily get the values 5L divided by 0.5. Just do it. Your calculator is divided by 0.5. You will get 10 lakhs. So 10 lakhs, which is the current liability. Current liability is 10 lakh. Okay. You have got the value of 10 lakh, which is current liability. Now he is asking us to find out what current assets. So current assets, we have net current assets, right? Net current assets, which is given here is how much? Or you can simply calculate 10 lakh into 1.5. 15 lakhs. Sorry. 10 lakh into 1.5. You will get 15 lakh is the right option. Because here we have took the value. Instead of current assets, we took 1.5 CL. So at CL, you just substitute the value 10 lakh. 1.5 into 10 lakh, you will ultimately get the option C is the right answer, 15 lakh. Okay. So moving to the question number 72. Secondary market in India is regulated by whom? It's quite easy question if you just go through with the theory parts. SEBI, Reserve Bank of India, is not regulating the secondary market as well as Ministry of Finance. Nowhere it is said that the Ministry of Finance and the Forward Market Commission of Reserve Bank of India is regulating the secondary market. So ultimately, the secondary market, which is nothing but stock market, is regulated by whom? Security and Exchange Board of India. So what are they? NSE and BSE. Okay. So 73. Return on assets and return on investment ratios belong to. It's quite easy. We have discussed under the heading of profitability ratios, right? So returns are return investment as well as assets is nothing but profitability ratios. Nowhere we have said that the liquidity ratio or solvency ratio. Move to the question number 74. The annual growth rate is 50% of the cost of equity. So he's saying as 50% of KE, right? And the dividend yield is 9.1 by 11, which is nothing but 0.90909 percentage. And the cost of equity would be, he's asking us to calculate the KE, but he is given that the annual growth rate is 50% of KE. Okay, you must be careful here. So cost of equity, which is equal to KE is equal to dividend yield plus again growth rate. So dividend yield which is given here is 9.090909 and the growth rate which is given here is 0.5 into K. Okay, so K is equal to. So now you just simplify this. Okay, you just get the KE here this side. So that is ultimately KE minus 0.5 KE, that is equal to 9.090909. You can just keep on drawing these values. Okay, so KE 1 KE minus 0.5 KE, that is ultimately 0.5 KE is equal to 9.090909. So K is equal to 9.0, which is nothing but percentage. This is given in percentage. You just convert this into decimals. Then ultimately you will get K is equal to 0.09090909. It keeps going. 0.5. If you do that, you will get the value. Okay. That is nothing but 0.0909090909 divided by 18.88. Option A is the right option. Okay, clear? So, moving to the question number 75. Which among the following is not an assumption of net operating income approach? Assumption. He's asking us the assumption. So, while solving the capital structure problems, we have discussed a lot of theories, right? So, net operating income is one of the one theory we have discussed. So, in which we have discussed the list of assumptions. So, what is the assumption which is not related to the net operating income he is asking us to find? Okay, so what are the options? Just go through with the options. Option A, value of the firm remains the same. Option B, cost of debt remains the same. Option C, cost of capital remains the same. Option D, cost of equity remains the same. Now tell me which is the right option. Which is the right option? Option D, cost of equity remains the same. So moving to the question number 76. Calculate the risk-free rate of return if the value of beta is 1.5 market rate and 30% and cost of equity is 16%. So these are just formula-based questions, I think, right? So we have to just K is equal to, already you know that, right? So risk-free RF, okay, plus beta into RM minus RF. If you just substitute the values in the question, you will find the answer. So, okay. So step by step, I don't want to solve and waste our time. Okay. So it's quite easy to calculate the value. So ultimately, you will be getting D as the right option. Okay. Because I have calculated it already. Okay. So in this separate session, we have to save our time. Okay. So moving to the question number 77. The current assets of BOT Limited is rupees 4 lakh, while quick ratio is 1.80:1. If the current liabilities are 2 lakh, what will be the value of stock he is asking us to find out? So quick ratio, already you know that quick ratio is equal to quick assets divided by quick liability, right? So quick assets divided by quick liability. So if you just substitute the values over in this formula, so we'll be able to find out the what quick assets, right? So what is the formula for the interruption? There is a slight network issue. So moving to the question number 77, the current assets of BOT Limited is rupees 4 lakh. Okay, current assets which is given. Well, quick ratio is 1.80:1. If the current liabilities are 2 lakh, current assets as well as current liabilities both are given. What will be the value of stock is asking? So with the quick ratio, you have to calculate the value of stock. It's quite easy. You need not make it complicated. So quick ratio, already you know that, right? Sorry. Quick ratio is equal to quick assets divided by like current liabilities, right? Current liabilities, which is given in the formula here is, sorry, given in the question is 2 lakh, right? So now you need to calculate the quick assets. Quick assets is equal to quick ratio into current liabilities. You can easily calculate. So quick ratio, which is given 1.80, right? Into 2 lakh, if you do, then you will ultimately get the quick assets value, which is nothing but 3,60,000. So since quick assets is equal to current assets minus stock, already you know that. Quick assets equal to current assets minus stock. So if you substitute the value, quick assets is 3,60,000, that is equal to 4 lakh minus stock. So you'll ultimately get the value 3.6 lakh minus is equal to 4 lakh minus stock. So if we just bring this here and bring that here. So okay, then you will get stock is equal to 4 lakh minus 3,60,000. Ultimately, the option C is the right option. So moving to the question number 78. The present value of total cash inflows of a project for 5 years is rupees 3,37,050 rupees. If the profitability index is 1.05, what will be the cost of the project? So it's quite easy. So PI is equal to profitability index equal to present value of total cash inflows divided by initial investment. Just keep remaining the formulas. So profitability index equal to present value of total cash inflows divided by initial investment. Present value of total cash inflows divided by initial investment. So if you just substitute the values, so first we need to find out the what initial investment here, right? So what are the values given in the question? So cash inflows, total cash inflows of a project for 5 years is 3,37,050 rupees, right? So initial investment is equal to, we have to find present value of total cash inflows divided by profitability index. Just you can send the denominator to the left hand side and the left hand side value to the denominator. Okay. So cross multiplication type. So initial investment is equal to 3,37,050 divided by 1.05. You will get the value which is 3,21,000. Option C is the right option. So you must be having clear idea with the formula, how to implement the event. Okay, 79. Which of the following is not an assumption of the capital asset pricing model? The capital market is efficient. And moving to the second option, investor decisions are based on a single time period. Option C, investors lend or borrow at a risk-free rate of return. Option D, investors do not have the same expectation about the risk and return. So the right answer, which is yes, easily you can say this type of questions. It's quite easy. Option D, investors do not have the same expectation about the risk and return. So moving to the question number 80, given risk free rate of return is equal to 5%, RF equal to 5%, RM is equal to 10%, K is equal to 3%, value of beta is asking. You can easily simply calculate this value RF plus beta into RM minus RF if you find K is equal to. So if you just substitute the values in the given formula, you can easily get the answer. So the answer which is here is, don't want to waste the time, 2.0. Okay, as the subject is which is FM, it takes much more time to finish it off. Okay, so moving to the question number 81, which of the following cost of capital required to adjust tax? Absolutely, this cost of debenture, right? You need not even think about the options. Cost of debenture is the right option. So you have to just search for the option where it is available, whether in A, B, C. So we have such in the same way. So option D is the right option. So 82, marginal cost of capital is the cost of additional funds or additional revenue or additional interest. It's ultimately additional funds, right? Marginal cost of capital. It's additional funds. Okay. So in order to calculate weighted average cost of capital, weights may be based on market values, book values. Okay. So it could be anyone, target values. So option D is the right option. Clear? So moving to the question number 84. A company cost of capital is the average cost of a company's cost of capital is the average cost of. Yes, it's quite easy. All source of finance. Clear. Okay. Which of the following statement is fall in the context of plan explaining the concept of capital structure of a firm? Following statement is false. Is asking in a negative manner. Okay. In the context of explaining the concept of capital structure of a firm. Okay, it resembles the arrangements of the various parts of a building, the relationship between equity and debt. It represents the relationship between fixed assets and current assets, combinations of various long-term resources. So here, as I told you, you can easily like eliminate the options. Okay, he's asking the false one. So option D is the right option. It resembles the arrangements of the various parts of yes, that's the right option. The relationship between equity and debt, exactly. So option C is the relation between fixed assets and current assets, how it's relevant. Okay, so that's a wrong one, false in the context. Okay, so the option C is the right option. Moving to the question number 86, the assumptions of hypothesis of capital structure do not include the following. Again, here they are asking the assumptions. So if you have clarity, so for the option A, capital markets are imperfect. How come capital markets are perfect in hypothesis, right? So option A is the right option. So you need not even think about it multiple times. Just go with the flow. And as the answers we are getting is absolutely right? So moving to the question number 80 is 80? Yes, 7. Financial structure refer to. Financial structure refer to structure, which means all financial sources, right? That could be long term, short term, anything. If it's like cost of capital, then it is long term. Then go to the question number 88. An ABAT EPS indifference analysis chart is used for examining EPS results for alternative financial at varying what? Varying EBIT levels. That's the right option. You need not look for any other option. Evaluating the effects of business risk on EPS. How come? Determining the impact of a change in sales on EBIT. No. So examining EPS results for alternative financial plans at varying EBIT levels. That's what we do in the EBIT EPS analysis, right? So the term capital structure means, what does it mean? We have discussed in detail for what sake we are studying capital structure and what are the components here. Absolutely long-term debt, preferred stock and equity shares. These are the terms which we have discussed in capital structure, right? So the question number 90, market values are often used in computing the weighted average cost of capital because of what reason? Because this is consistent with the goal of maximizing shareholder value, because this is not a very common mistake as is required by nobody is said, right? So this is a simple way to simplest way to. So if someone asks whether it is book value or market value, which is easier to compute, definitely book value, right? So moving to the question number 91, a company's optimal capital structure. Optimal capital structure, what does it mean? Yes, it's absolutely is the debt equity ratio that results in the maximum possible weighted average cost of capital, right? So the optimal capital structure is the debt equity mix that minimizes the weighted average cost of capital, right? So when a company finds this optimal balance, it maximizes the firm value and minimizes the cost of financing, leading to the most efficient use of capital, right? Okay. So whereas when a cost of equity is minimum, so is incorrect because the optimal capital structure involves balancing the both debt and equity to minimize the weighted average cost of capital. So if you want to minimize the weighted average cost of capital, you must introduce the debt because the KO is always lies between what? KD, right? So moving to the question number 92, which one of the following is the assumption of Gordon's model, retention ratio once. Okay. So option A here it is, what is it? Retention ratio, which is considered as B, right? In our problem, once decided upon is constant. K is greater than G. Firm is on all equity firm. Yes. D is all of the above is the right option. Okay. Moving to the so because how you may ask her how come how you're just rounding the answers are like options because these all are the things which we have discussed in our regular classes. Simply, I will say. Okay, moving to the question number 93. Which of the following is the irrelevance theory? You need not think about it. You need not waste your time. Which is the irrelevance theory? Minimum hypothesis. Okay. So moving to the question number 94. If the company's dividend payout ratio is 60% and return on investment is 16%, what should be the growth rate? Already we have discussed. Growth rate which is equal to ROI into retention ratio. Already, simply we have to find the retention ratio. If the dividend payout ratio is 60%, then the 40% remaining portion is the retention ratio, right? So if you want to find out the growth rate, return on investment into retention ratio, 16% into 40%, if you do, then you will get 0.064, which is nothing but 6.4%. So moving to the question number 95, if the shareholders prefer regular income, how does this affect the dividend decision? So it's definitely affect the dividend decision because if shareholders prefer regular income, it typically leads to the payment of dividends, right? So this is because shareholders who prefer regular income will want the company to distribute a portion of its earnings to them as dividends. So rather than returning the earnings for reinvestment in the business. Okay. So therefore the correct answer which is it will lead to payment of dividend. So option A is it is the indicator to retain more earnings. How come if the investors are expecting a regular dividend? Okay, if the shareholders, how can you can retain more money in the business? No, right? It has no impact on dividends. How come if you are expecting a more return, so it must be satisfied by issuance of dividends. So how come? Yes. So okay, moving to the question number 96. Just give me a second. Further delay. Question number 96. Which of the following is the limitation of Linter model? So there are options given here. Option A, the adjustment factor is an arbitrary number and not based on any scientific criterion or methods. Option B, this models does not offer a market price for the shares. Option C, both A and B. So whenever there is an option called both A and B or all of the above, you must be careful. Okay. And D, none of the above. So what could be the answer? So obviously the limitations of the Linter model include the adjustment factor which is used to decide the dividend payout ratio is arbitrary and not based on any scientific methods, as well as the model does not provide a clear indication of the market price for shares. Okay, which makes it less useful in practical application. So the right option which is both A and B. So moving to the question number 97, given operating fixed cost rupees 20,000, sales rupees 1 lakh and PV ratio 40%, then the operating leverage is. So already you know that operating leverage which is equal to contribution divided by EBIT, which is nothing but EBIT is your operating profit. Okay. So with these values, given values, you must find the operating leverage. Okay. So operating leverage which is equal to contribution divided by EBIT, right? So with the help of PV ratio, you can find out the contribution, right? So sales contribution is equal to sales into PV ratio, right? So sales, what is the value of sales here? So sales which is 1 lakh into 40%, which is nothing but contribution 40,000 rupees. Okay. And moreover, Operating profit, which is equal to contribution minus operating fixed cost. If you deduct the values from the 40,000, if you deduct the value which is 20,000, you will get the operating profit, which is nothing but your earnings before interest and tax, which is nothing but EBIT. Okay. So in order to find out this contribution, sales into PV ratio, clear? You will be getting some value which is around 40,000. So our contribution is 40,000. Operating profit, in order to find out, you have to as you know that income statement, right? Sales minus variable cost, contribution minus operating fixed cost, that is equal to EBIT. So you'll be getting 40,000 minus operating fixed cost 20,000. You'll be getting 20,000, right? So which is equal, which is the answer, which is 2. Okay. Moving to the question number 98. If EBIT is rupees 15 lakh, interest rupees 2 lakh 50, corporate tax 40%, then degree of financial leverage. So earlier he asked the operating leverage. Now he is asking the degree of financial leverage. So which is nothing but EBIT divided by EBIT minus interest. So interest is, which is nothing but 1 minus tax rate. Clear? So if you substitute the values in this formula, okay, you will be able to find out the answer. So if you ultimately use this formula and implement the values, then the answer would be 1.00, because we have calculated. So with the relevant formula, if you calculate the values, you will be getting the answer. So moving to the question number 99, operating leverage is computed as contribution divided by EBIT. Okay. Question number 100, financial leverage is computed as EBIT divided by, yes, EBT. Clear? So question number 101. So till now we have finished 100 MCQs. So still more 100 MCQs are left. Okay. So please be careful. Okay. So 101, which one of the statement is correct concerning the weighted average cost of capital of any firm? The weighted average cost of capital may decrease as a firm's debt equity ratio increases. It is one of the question which is asked in the 2022 syllabus. Okay. During exams. Okay. Which one of the following statement is correct? He is asking which is the correct answer. Okay. Concerning the weighted average cost of capital of any firms. The weighted average cost of capital may decrease as a firm's debt equity ratio increases. Okay. And option B, the weight in the computation of weighted average cost of capital, weight assigned to the preferred stock is based on the coupon rate. No, right? So a firm's weighted average cost of capital will increase as the corporate tax rate increases. And that's too somewhat relevant. And option D, the weighted average cost of capital does not consider redeemable preference shares of the firm. Who said it won't consider? It will be considering, right? So which is the right option? So it is already asked in the examination. Okay. So the answer, which is A here, because weighted average cost of capital may decrease as a firm's debt equity ratio increases, because when the debt ratio is increasing, ultimately your KO will get decreased, right? So option A is the right option. So 102, X Limited is considering an investment proposal involving an initial cash outlay rupees 20 lakh. Okay. The proposal has an expected life of 7 years and zero salvage value. At a required rate of 12%, the proposal has a profitability index of 1.182. Calculate the present value of cash inflows. The present value of annuity of rupees 1 for 7 years at 12% discount is 4.5638. So already in the question, it's clearly given easy values. You need not get confused here. So with the help of profitability index, you can calculate the present value of cash inflows. How, sir? So profitability index formula, PA is equal to what? Present value of cash inflows divided by initial cash outlay. Already you are having the value which is initial cash outlay, which is 20 lakh. So with the help of profitability index value 1.182, just cross multiply this value. So from the denominator to the left hand side to the numerator, 20 lakhs into 1.182, right? So PA is equal to initial cash outlay. Sorry, initial, what is it? So initial present value of cash inflow, sorry. Once again, present value of cash inflow divided by initial investment. Clear? So the profitability index, which is 1.182, that is equal to present value of cash inflows. So you have to find out, right? So let the value be X or something. Initial investment 20 lakhs. If you send this to this left hand side to the numerator, you will be getting the value 20 lakhs into 1.182. You will get 23 lakhs 64,000 as your present value of cash inflows. It's quite easier, right? So you need not consider all the remaining information, required rate of return, zeros, 7 years of 0 salvage value, right? So moving to the question 103, the signs of large inventory and build up in anticipation of price increase in future can be best diagnosed from which ratio? Which ratio it is? It's inventory turnover ratio. Clear? Okay, moving to the 104. MJ Limited has issued 5,010% debentures of rupees 100 each. The rate of inflation is 6%. Calculate the real cost of debt. They have given that 5,000 10% debentures of rupees 100 each. With the formulas only, you can easily calculate, right? So he is asking the real cost of debt. So real cost of, whenever they are asking real cost of debt, you can use these values. Just give me a second. 1 plus nominal rate divided by 1 plus inflation rate. Okay. Oh, minus 1. So here already the values which are given. Nominal rate, inflation rate, both are given. 1 plus 10%, 1 plus 6%. That is minus 1. If you substitute the values, you will be getting the answer, which is 3.77%. Okay. So moving to the question number 105. A commercial paper of the face value of rupees 10 lakh is issued at 9,60,000 for a maturity period of 120 days. The annual financing cost of the commercial paper is, what is that? Annual financing cost he is asking us to find out. Clear? So then the face value minus issue price divided by issue price. Okay. Annual financing cost into 365 divided by maturity period in days into 100. So if you substitute the values in this formula, you will be getting the answer. Okay. That is nothing but 12.7%. Okay. And moving to the question of 106. If the cost of the project is rupees 22,84,000, the useful life is 5 years and the annuity is rupees 8 lakh, then the payback period, it's quite easy. Payback period is equal to cost of project divided by annual cash inflow, right? So what is the cost of project? 22,84,000. Annual cash inflows, he is saying that 8 lakhs, right? Then it is 2.855 years. So it is nothing but 2.855, 0.85 into 12. 0.855 into 12. If you do that, you will be getting, you are getting 10.26, which is nothing but 2 years, 10.26 more than 10. So 11 months. So 2 years, 11 months is the right option. Okay. So moving to the question number 107. If the annual demand of raw material is 20,000 units, the price per unit is rupees 2, and the ordering cost per order is rupees 2,000, and the carrying cost percentage of average inventory is 10%, then the number of orders based on EOQ will be EOQ 2AO divided by C. 2 annual quantity demanded in units. 0, sorry, O ordering cost. C carrying cost per unit, ordering cost per order, annual demand in units. If you substitute the values, you will be getting the answer, right? So it's quite easy. So you'll be getting the EOQ value will be, if you substitute the values in this formula, you'll be getting 20,000 units. Okay. So how many order you are supposed to place? In order to cover the 20,000 annual demand units, you need to place one order. Okay. So option C is the right option. So 108, if the average receivables are rupees 3,25,000. Okay. And the cash sales are 2,50,000 and the average collection period is 2 months, then the amount of sales is. So already in the given question, he is asking us to find the what is asking us to find out the value, the amount of total sales. Okay. So in the question he is given that amount receivable, sorry, average receivables, which is nothing but 3,25,000, cash sales 2,50,000, average collection period 2 months. So first you need to find out the annual credit sales. So average receivables arises when there is a credit sales, right? So annual credit sales equal to average receivables into 12 divided by average collection period, right? Annual credit sale. Because in question cash sales is already given. So cash sales plus credit sale is equal to total amount of sales. So in order to find out the credit sales with the help of average receivables, you will be able to find the values, right? Average receivables into 12 months divided by average collection period. So average collection period is also given 12 divided by 2 into average receivables, which is 3,25,000. If you substitute the value 6, 3,25,000 into 6, what is the value? This is 19,50,000. 19,50,000 plus 2,50,000, what is it? 22 lakhs. Option B is the right option. Okay. Question number 109. The Petrosky F score, which measures a stock's financial condition, is based on. It's a theory question, right? What is the answer? Yeah. Option A, binary scoring system based on 9 parameters, because the Petrosky F scores uses a binary scoring system across the 9 financial parameters to assess a company's financial strength. Okay. So moving to the question number 110. The constant dividend growth model is useful for, we have discussed. We have discussed the mature industry, growth-oriented industry. We have discussed the constant dividend growth model is used for mature industry. Okay, so the constant dividend growth model assumes steady, predictable dividend growth, which is more realistic for mature industries with stable earnings and dividend policies. Clear? So moving to the question number 11, 111. OASIS committee has given recommendations in the area of OASIS. Yes, that's pension policy. Okay. So 112 dash is annual growth of investment over a specific period of time. So CAGR is the compound annual growth rate, which we have seen in our regular classes, right? So which represents the rate at which an investment grows annually over a specific time period. Okay, so question number 113. Selling shares without owning them to buy back at a future date at a lower price in the expectation that price will drop is known as what? Selling short. Already it is asked in some other way, right? We have answered this question already. Selling short. Okay, moving to the question number 148. 91-day treasury bill with face value of rupees 100 is issued at rupees 98. The annualized yield on the same would be dash. So it's again the simplest one. Again, you need to follow the same formula: face value minus issue price divided by issue price into 365 divided by days to maturity. If you implement the values in the formula, you will be able to get the answer. So it's quite easy. So then the approximately you will be getting 8.18%. Clear? So try to solve the using this formula. Okay. And moving to the question number 115. Dash shows that the current dividend depends upon partly on current earnings and partly on previous. Who discussed this? Who said this theory? Dash shows that the current dividend depends partly on current earnings and partly on previous year's dividend. Current year is partly part on current year earnings and partly on previous year dividend. Who told this? You must have the knowledge of what are the like kind of economists what they have proposed in the theory. So it is said by Linter model. Okay. So 116. So in this manner, you can also like revise your concepts. Okay. So in this scenario, you will be like able to learn that the Linter model under the Linter model only, it is said that the current dividend depends partly on current earnings and partly on previous year's dividend. Okay. So moving to the question number 116. Rogers Polymers Limited issued rupees 4 lakh 9% perpetual debentures at a premium of 10%. The cost of flotation are 2%. The tax rate is 50%. What is the after tax cost of debt? It's quite easy. You must use the formula again. Okay. So in order to find the what is asking us? Calculate the after tax cost of debt, right? If you use the formula, you will be able to find out the answer. Okay. First, you need to calculate the issue price of the debenture. What is the issue price? Face value plus premium. Okay. Here the face value which is 4 lakh and premium which is 10% of 4 lakh 40,000. Then the issue price which is 4 lakh 40,000. Now you have to calculate the flotation cost. So flotation cost are calculated on the issue price 4 lakh 40,000 into 2%. What is that? 8 lakh 80,000. So the net proceeds you will be arriving at 4 lakh 40,000 minus 8,000. The net proceeds which is 4 lakh 31,200. Right? So net proceeds we have when there is a market price or net proceeds given, you have to consider market price. So we have calculated the net proceeds also here. Then you have to calculate the interest payment. What is the interest payment? 9%. 9% of 4 lakh, which is 36,000. So you just substitute the values in the formula and the after tax cost of debt, you will be getting the answer, which is 4.17%. Okay. And moving to the question number 117, the pecking order theory has emerged as an alternative theory to pecking order. It's quite easy. Already we have discussed, which is trade-off theory. In our theory part, we have discussed, right? So moving to the question number 118, how long it will take for rupees 1 lakh to double at a compound rate of interest of rupees 12% per annum, approximate. It's quite simple. To all my dear students, I have explained it in a simple way. 1 lakh to double at a compound rate. So you just keep on 1 lakh, 12% once, 12% twice, 12%, 12%, 12%, 12%. So almost it took around 6 years. Clear? It took 6 years. 6 times I have like then the calculation. Okay. So then I am able to get the doubling. Okay. Also, there is a formula called doubling period, which we have discussed in our regular classes. In order to save our time, it's the simplest question. So we have to follow the techniques. Okay. In order to save the time. So moving to the question number 190, following information has been given, taken from the balance sheet of MJK Limited, 8% debentures payable, rupees 15 lakh, 12% preference shares, rupees 15 lakh, and ordinary shareholders equity is rupees 40 lakh. You have to calculate the capital gearing ratio out of the capital gearing ratio of the company. He is asking us to find out the what capital gearing ratio. What is the formula for capital gearing ratio? Fixed interest bearing capital, which is debt plus preference shares divided by equity capital. Okay. What is the value of fixed interest bearing capital? Debentures 15 lakh, preference shares 15 lakh, which is 15 plus 15, 30 lakhs divided by ordinary equity shareholders Okay, which is 40 lakhs. So 30 lakhs divided by 40 lakhs, which is 0.75. 0.75 is nothing but 4:3. Clear? So moving to the question number 120. Systematic risk of the firm is 1.5. 182 days. Treasury bills currently yield 9%. Expected yield on the market for portfolio of assets is 14%. RM 14%. RF 9%. Beta 1.5. You are supposed to find out the cost of equity. So just use the formula CAPM method, right? So KE is equal to RF plus beta into RM minus RF. If you just substitute the values in the formula, you will be able to get the answer. Then the answer here. Please try to solve it. Just pause the video and try to calculate the values. It's a most important one of the question which is repeatedly asked in the examinations. Okay, the answer which is 16.5%. Moving to the question number 121. The cash outflow for a project is rupees 2 lakh. The cash inflows are expected to be generated are rupees 1,20,000 at the end of the first year and rupees 1,60,000 at the end of the second year. If the discounting rate is 10%, the profitability index 6. You have to follow the profitability index formula. You just get the profitability, present value of cash inflows divided by more number of times we have used this formula called profitability index. You must be able to answer the questions. Profitability index is equal to present value of cash inflows divided by initial cash outflow. Present value of cash inflows. So the values which are given here is at the end of the first year as well as second year. You have to use the discounting rate 10% and you have to bring it to the present value. So 1,20,000 to the present value, 1,60,000 to the present value. Okay. So then you have to use the formula present value of cash inflows divided by the initial cash outlay, which is nothing but 2 lakhs. So if you substitute in the formula, then you will be getting the answer, which is 1.21, which is approximate. Okay. So moving to the question number 122. Average collection period is 3 months. Cash sales and average receivables are rupees 3 lakh and 4 lakh. The total amount of sales. Again, it's quite easy. He is given that the average receivables, same formula. So average receivables into 12 months divided by average collection period, which is the annual credit sales, right? Already cash sales, which is given here 3 lakh and average receivables 4 lakh. 4 into 12 divided by collection period 3. 4 lakhs into 4, which is nothing but 16 lakhs, which is the annual credit sales plus cash sales, which is 3 lakh. 16 lakhs plus 3 lakh, which is 19 lakhs. Okay. So moving to the question number 123. Under ABC analysis method of stock control, A category items are absolutely they are smaller in quantity but larger in value. Without looking at any other option, you have to search for the right answer. Okay. Already know the answer. Smaller quantity in larger value. So that you have to search in the options. So option A is the right option. Moving to the question number 124. If the profit after taxes of a company is rupees 5,40,000, the preference dividend is rupees 60,000 and the dividend payable to 1,60,000 equity shares is rupees 2 per share, then equity dividend coverage ratio. What is the value of equity dividend coverage ratio? It's one of the quite easiest one. Clear? Try to answer. Equity dividend coverage ratio, which is equal to profit after tax minus preference dividend divided by equity dividend. So what is the profit after tax here? So you must clearly see the question. Look the question. So, okay, 5,40,000. Clear? Just give me a second. Sorry for the interruption. So, in the given question, he is asking us to find out the equity dividend coverage ratio. So, already you know that what is the formula for equity dividend coverage ratio? PAT minus preference dividend divided by equity dividend, right? PAT minus preference dividend divided by equity dividend. So the information all are which are given in the question, right? So profit after tax is 5,40,000. Okay. And moreover, the preference dividend is 60,000. So only thing which you are supposed to find out is, and the dividend payable to 1,60,000 equity shares is rupees 2 per share. So 1,60,000 equity shares per share, the dividend is 2 rupees. What about the 1,60,000 total dividend? So which is nothing but 3,20,000. Right? So if you substitute these values, then you will be able to get the answer, which is 1.50 times. Okay. So moving to the question 125. Current assets rupees 20,000, current liabilities 10 lakh, and stock rupees 2,000. What is the liquidity ratio? So liquid ratio, which is nothing but current assets minus stock divided by current liabilities, right? So current assets, which is 20 lakhs minus 2 lakh divided by 10 lakh. If you do that, then the answer which is 1.8 times. Okay, moving to the question 126. Annual credit sales rupees 44 lakh. Average collection period 45 days. What is the average debtors? Now they are asking us to calculate the average debtors, that is equal to annual credit sales into average collection period divided by 360. Because he is given that the assume in a year there are 360 days. So what is the annual credit sales? annual credit sales into average collection period divided by 360 days. Then the answer would be 4 lakh into 45 divided by 360. We substitute the values. If you calculate the values, then the answer which is average return which is 50,000. Moving to the question number 127. Investment in a project is rupees 200 lakhs and net present value is 50 lakhs. Then amount of inflows is. So easily you can calculate amount of inflows. So NPV which is equal to 50 lakhs. Outlay, present value of cash outlay is 200 lakhs. So what is the inflow amount? So it is quite easy. NPV is equal to total inflows minus initial investment, we used to say. So NPV is 50 lakhs. Total inflows we have to find. Okay. Let's say inflows be X minus 200 lakhs. So we get this value here. 250 lakhs would be the answer. Okay. Going to the question 128. PAT of a company, which is nothing but profit after tax of a company is rupees 100 lakhs and number of equity shares of rupees 10 each with a capital of rupees 50 lakhs. Then EPS is. So profit after tax is 100 lakhs. Number of equity shares of rupees 10 each with a capital of 50 lakhs. So 50 lakhs, each share is 10 rupees. Then the number of equity shares are, this is nothing but 50 lakhs divided by 10, which is nothing but what? 5 lakh, right? So, okay. So there are totally 5 lakh number of shares. So then 100 lakhs divided by 5 lakh shares. That is equal to rupees. EPS is 20 rupees. So option D is none of this because 20 rupees is the earnings per share. So there is no any option called 20 rupees here. So none of this is the answer. So degree of operating leverage is again operating leverage. What is that? Contribution divided by EBIT. Okay. Moving to the question number 130. Present value of inflows. Okay, rupees 10 lakh inflow. And from a project, and the initial investment is 7.5 lakh. So NPV what? Total. Just now we have calculated total inflows minus initial investment. Okay, which is what? 10 lakh minus 7.5. Then that is equal to 2.5 lakhs. Moving to the question number 131. Cash and bank rupees 20,000. Debtors 2 lakh. Okay, 2 lakh. Stock rupees 2.8 lakh. And current these are current assets. Current liabilities. Creditor 1 lakh, bills payable 50,000. Then working capital. Working capital is equal to current assets minus current liabilities, right? What is the value of total current assets? 20,000 plus 2 lakh, 2 lakh 20, 2 lakh 20 plus 2 lakh 80 what? 5 lakh. So 5 lakh minus 1 lakh 50. What is the value? 3.5 lakh. Okay, moving to the question number 132. 1 lakh 10% debentures of rupees 100 each of company. The interest payable for quarter is. So 1 lakh 10% debentures of rupees 100 each. So 1 lakh debentures there are. Okay. So there are 1 lakh debentures of rupees 100 in the sense 1 lakh into 100. 1 lakh into 100, which is equal to 1 crore. So in among 1 crore, you are paying that 10% as debenture interest. So it is equal to 10 lakh. So 10 lakh is for the year, right? Now it is divided for 4 quarters. Then it is equal to 2.5 lakh per quarter. So option B is the right option. So here the question is asking the interest payable for quarter. Okay. So there are total number of debentures is 1 lakh. So each debenture price is 100 rupees. So total debentures, 10% debentures value. What is the amount of fund raised with the help of debentures? 1 lakh into 100, which is equal to 1 crore. So for 1 crore, how much interest you are paying? 10%, which is nothing but 10 lakhs you are paying. So, but that 10 lakh you are paying by quarters, 4 quarters there are. So 10 lakh divided by 4, 2.5 lakhs. Okay. Moving to the question number 133. Degree of financial leverage is leverage of business indicates financial risk. Okay. Moving to the question number 134. Which of the following is not a characteristics of GDR? So what does it mean? GDR, Global Depository Receipts. So Global Depository Receipts are a financial instrument that allows company to raise capital in international markets. So what are the characteristics of that? So it includes, it is a negotiable instruments because GDRs are negotiable and can be bought or sold in the international market. And moreover, option C, freely tradable in international market because GDRs can be traded freely in foreign markets. Typically in stock exchanges, right? And moving to the option D, denominated in US dollars. GDRs are usually denominated in US dollars or any other major foreign currency. So, okay, but however, like GDR do not carry voting rights directly because they represent shares of a foreign company and the holders of GDRs typically do not have direct voting rights in the company. So instead, the depository bank holding the underlying shares may exercise the voting rights, but these are not passed on the onto the GDR's folder. So option B is the not a characteristics. Okay, moving to the question number 135. Which of the following is a feature of factoring? So what is a feature? Which is what factoring? So factoring is one of a financial service where a business sells its receivables, right, to a third party. So the to a third party is called a factor. Okay, at a discount. Okay, in exchange for immediate cash. So it's commonly used as a short-term financing option to improve the liquidity. So it helps businesses manage cash flow by turning receivables into instant cash. So factoring can be done with or without recourse. Okay, and it is not limited to export businesses only. So okay, so it is a tool of short-term borrowing. So moving to the question number 136, which of the following is a profitability ratio? Yes, which is what? Price earning ratio, property ratio, debt equity ratio. Those are fixed assets. Those are not the profitability ratio. Move to the question number 137. EBIT rupees 11 lakh 20,000. PBT 3 lakh 20,000. Okay, 11 lakh 20,000. Fixed cost 7 lakh. Operating is asking us to find out the operating leverage. Operating leverage again contribution divided by EBIT. So profit before tax, okay, 3 lakh 20,000. Earnings before interest and tax, okay, which is what? 11 lakh 20,000. So simply you have to calculate the operating leverage is equal to EBIT divided by EBIT minus fixed cost. We substitute the values here, 11 lakh 20. Okay, again 11 lakh 20 minus 7 lakh. You substitute the values over the formula, then you will be able to get the answer, which is equal to 2.67. That is, which is approximately 2.625. Okay, determinants of credit policy relates to what? So, option A, credit standards, credit terms, collection. Yes, all of the above. Question number 139. The following is not a discounted cash flow technique. NPV is a discounted profitability index. Accounting of average rate of return is not the discounting technique, right? Option C is the right option here because it is not a discounted cash flow technique. Following method is also known as benefit cost ratio. Benefit cost ratio, profitability index. Okay. So, moving to the question number 141. Okay. So, moving to the question number 141. Working capital management. Working capital management refers to a trade-off between what? Dash and profitability. Dash and profitability. Yes, it's quite easy. Liquidity and profitability. Clear? So option one, so question 142. Find the present value of rupees 1,000 receivable 6 years. Hence, if the rate of discount is 10%. So he's asking us to find out the present value by using the present value formula. What is that? Present value formula. So future value divided by 1 plus r whole power n. So all the values are given here. N is equal to 6 and r is equal to 10%. If you just substitute the values, you will be getting present value, which is 564.47. So which is ultimately 564.5. Okay. Moving to the question 143. IPO refers to dash. The first time a company comes to public to raise money, immediate public offering, initial public offering. Okay. So initial public offering is the right option. So moving to the question 144. Ratio analysis is the process of determining and interpreting numerical relationship based on the financial statements. So 145. Ratio analysis based on dash measure. Relative or absolute? Relative measure, not an absolute measure. Okay. The term operating profit means operating profit before interest and tax. Okay. Interest or tax, it's interest and tax. Debt equity ratio is an example of. It's quite easy. You must be able to answer the question. Okay, question number 147, right? Debt equity ratio is an example of. So debt equity ratio is an example of long-term solvency ratio, right? So in which debt and equity ratio is, what are the things which includes debt as well as equity? Both are long-term related, okay? So long-term solvency ratio. So moving to the question 148, fund flow statement reveals the change in dash between two balance sheet dates. Or A, option A, working capital, B, internal capital, C, share capital, and D, both A and C. So what is the right answer here? So fund flow statement reveals the change in working capital. Okay, fund flow statement shows the changes in working capital, which is current assets minus, okay, current liabilities. Just give me a second. 1 second. Okay. So moving to the question number 149. Your firm following an aggressive working capital strategy would hold substantial amount of fixed assets, and option B, minimize the amount of short-term borrowing. Option C, finance fluctuating assets with long-term financing. D, minimize the amount of funding, very liquid assets. So aggressive working capital strategy would be minimizing the amount of short-term borrowing, right? So then only you can reduce the current liabilities, right? Moving to the question 150. Which of the following would be consistent with a conservative approach to financing working capital? Financing short-term needs with short-term funds. Option B, financing short-term needs with long-term debt. Financing seasonal needs with short-term funds. Option D, financing some long-term needs with short-term funds. So what is the right option here? Option B, because financing short-term needs with long-term debt. Okay. So it's a conservative approach to financing a working capital, because a conservative approach to financing working capital involves using long-term funds to finance the short-term working capital needs. So because this ensures the stability and avoids the risk of having to roll over short-term debts. The other options represent more aggressive or flexible approaches. Okay. So moving to the question number 151. To financial analyst, net working capital means the same thing as what? Current assets minus current liabilities. Okay. Under Baumol's question number 152, Baumol's model of cash management attempts to what? Minimization of total cost. Just look for that. So option C here is minimization of total cost. Moving to the question 153. Okay. So 153 here, which of the following is not considered by Miller or model? So Miller or model, option A, variability in cash requirement. Option B, cost of transaction. Option C, holding cost. Option D, total annual requirement of cash. So here, total annual requirement of cash is not considered by Miller or model, because under the cash management model that helps Miller or model, that helps in determining the optional cash balance level by considering factors like variability in cash requirements, transaction cost, and holding cost. So it does not take into that account the total annual cash requirement, as it focuses on managing cash flow fluctuations within certain limits. Clear? So moving to question 154, a firm is said to be a financially unlevered firm if the firm has option A, only external equity in its capital structure. Option B, only owner's equity in its capital structure. Option C, both external equity and owner's equity in its capital structure. Option D, only equity share capital in its capital structure. So the optimal capital structure is the mix of debt and equity financing that minimizes the firm's overall cost of capital. Thus, which is ultimately maximizing the firm's value. So by achieving this balance, the firm can reduce its financing cost and improve profitability. So the right option, which is the overall cost of capital, is minimized. Option A. So sorry. So we are discussing question 134. A firm is said to be financially unlevered firm if the firm has, sorry. Option A, only external equity in its capital structure. Okay. So question 154 we have to discuss, right? So your firm is, so sorry for the inconvenience. So we are discussing the question number 154. So please be careful. 154, a firm is said to be financially unlevered firm if the firm has, what we are asking, he is saying that a firm is said to be financially unlevered firm. Unlevered firm means there is no any debt in its capital structure. Only external equity is in its capital structure. Only owner's equity in its capital structure. See, both external and equity. So, however, there is no debt. So, which means there is only owner's equity in its capital structure. Option B is the right option. So, moving to the question 155. The term of optimal capital structure implies that combination of external equity and internal equity at which the overall cost of capital is minimized, because external equity and internal equity, the combination, the capital structure is implying what? The cost of capital is minimized. Moving to the question 156. Net income approach to capital structure decision was proposed by whom? Quite easy. Duan's model, right? So 157. There is a reciprocal relationship between whom? DOL and DFL, degree of operating leverage and degree of financial leveraging. Then only ultimately it's for combined leverage. Okay. So the genesis of financial risk lies in which one? Financial risk lies on the capital structure decision, because financial risk does not lies on the capital budgeting, because you are utilizing the funds. So while raising the funds only, the financial risk is arising. So capital structure decision. Okay. So moving to the question 159. Financial break-even point is that level of EBIT at which EPS equal to 0, right? So question 160, payback period in which an expected cash flows are discounted with the help of project cost of capital is classified as what? Discounted payback period. Okay. So question 161, number of years forecasted to recover an original investment is classified as number of years forecasted to recover and original investment is classified as payback period or forecasted period of. So obviously it's a payback period. So in proper capital budgeting analysis, we evaluate incremental what? Incremental cash flows. So moving to the question 163, the term mutually exclusive investments mean. So option A, choose only the best investments. Option B, selection of one investment precludes the selection of an alternative. Option C, the elite investment opportunity will get chosen. Option D, there are no investment options available. So the option here is B, because selection of one investment precludes the selection of an alternative. Because mutually exclusive investments mean that the selection of one project excludes the possibility of choosing another. So this is common when two projects fulfill the same purpose or require similar resources. So making it impossible to undertake both. Okay. So here option B is the right option. Moving to the question 164. In mutually exclusive projects, projects which are selected for comparison must have positive NPV. Then only you can compare, right? Okay. So because when comparing mutually exclusive projects, only projects with a positive NPV are considered, as these add values to the firm. So projects with negative NPV should be excluded since they do not meet the profitability criteria, right? So moving to the question 165. Okay. So in a single project situation, results of internal rate of return and NPV led to what? Same decision, right? So there are no any other different decisions, right? So question 166. Because for a single project, the IRR and NPV methods typically lead to the same decision regarding project acceptance. So if the NPV is positive, the IRR will generally exceed the required rate of return, both indicating the project is financially viable, right? So moving to the question 166, the discount rate which forces NPV to become zero is classified as IRR. So IRR is said to be where the NPV is equal to zero, then it is said to be IRR, right? So moving to the question number, because the IRR is the discount rate at which the NPV of a project class becomes zero, right? We have discussed in our regular classes. So it represents the project break-even cost of capital where the investment neither gains or nor loses value. Okay. Question number 167. Time value of money explains that option A, a unit of money received today is worth more than a unit received in future. Option B, a unit of money received in today is worth less than a unit received in future. Option C, a unit of money received today and at some other time in future is equal. None of the above. It's quite easy because a unit of money received today is worth more than a unit received in future. Because the time value of money concept states that a unit of money today has more value than the same amount in the future due to its earning potential. So this principle is based on the opportunity to invest and earn interest on returns over time. So option A. 168. The time value of money facilitates comparison of cash flows occurring at different time periods by how? Compounding all cash flows to a common point of time, or discounting all cash flows to a common point of time, or option C, using either A or B, neither A or B. So neither A or B is not a right option. We can use anything, compounding all cash flows to a common point or discounting all cash flows. So option C is the right option. So moving to the question number 169. If the nominal rate of interest is 10% per annum and frequency of compounding is 4, that is quarterly compounding, the effective rate of interest will be. So here the effective rate of interest will be like, one second, 1 plus nominal rate divided by compounding periods, whole divided by compounding periods minus 1. Okay. If you do this, so 1 plus 10% divided by 4, whole divided by 4 minus 1, you will get the value which is 0.1 divided by 4 plus 1 into 2, 3, 4 minus 1, which is equal to 10.38%. You will be getting the answer. Okay, if you substitute the values and calculate the amount, then you will be getting 10.38% is the option. So option B is the right option. So question number 170. Okay, a student takes a loan of rupees 50,000 from SBI. The rate of interest being charged by SBI is 10% per annum. What would be the amount of equal investment if he wishes to pay it back in 5 installment, and first installment he will pay at the end of year 5? Okay, so with the formula you have to find the answer. So with the formula, if you try to solve the answer, so you'll be getting, so because this is an example of loan repayment with equal annual investment, where we need to calculate the amount of each installment using the present value of annuity formula. So hope you know that, because we have discussed in our classes, right? So using the present value of annuity formula, so you can calculate. So there is a delayed start of payments, right? This becomes an ordinary annuity calculation. Okay, starting from the end of year 5. So with a principal of rupees 50,000 and at an interest rate of 10% and a repayment period of 5 years. So the installment amount calculates to approximately, so by using the formula, if you calculate, you will be getting the answer which is 19,310 because it's an annuity method. Okay. So you must remind the formula and you have to calculate it. Okay. So these are the silly, easy questions. You should not spend a lot of time here. So question 171, how much amount should an investor invest now in order to receive 5 annuities starting from the end of this year, rupees 10,000, if the rate of interest offered by bank is 10% per annum. So, okay. So here in this question, it involves calculating the present value of annuity. Using the present value of annuity formula with a rate of 10% and 5 annuities of rupees 10,000, the present value comes to, if you use the formula, approximately. So you will be getting the value which is 37,910 rupees. So here it is future value of annuity. Here it is present value of annuity. Okay, question number 172. A bank offers 12% compound interest payable quarterly. If you deposit rupees 2,000 now, how much it will grow at the end of 5 years? Okay, again is equal to, you substitute the values in this formula, you will be able to get the answer. So approximately you will be getting 3722 as your answer. Okay. So just these are the time value of money questions. So next question, a company wants to repay a loan of rupees 5 lakh 10 years from today. What amount should it invest each year for 10 years if the funds can earn 8% per annum? The first investment will be made at the beginning of this year. Okay. So since this question involves equal investment with the first payment at the beginning of the period, so it uses the future value of annuity due formula. So try to solve this question with the annuity due formula. Okay. And if someone knows all these formulas, please list them all in the comment section so that it will be like useful for the students, those who are getting prepared for the exams. Okay. So given an interest rate of 8%, period of 10 years, and a target of rupees 5 lakhs. So the annual investment calculates to approximately what is the value if you use the present. So I'm not listing the formulas here because all the students, those who are watching, please try to give your formula so that you can revise it, or those who are the students, those who are getting prepared for the exams, they can revise it. Okay. So here the answer would be, I'm not like listing the formula here because as you know that, because you must make yourself involved. Okay. So the right option, which is 31,950 rupees. Okay. So moving to the question 174, risk of two securities having different expected return can be compared with what? So here the coefficient of variance is a measure of relative risk. Okay. Because the standard deviation divided by the expected return, particularly useful for comparing the risk of securities with different expected returns, as it adjusts for scale and not allows for the direct comparison. So coefficient of variance. Moving to the question 175, a portfolio consists of two securities and the expected return on two securities 12% and 16%. Calculate the return of portfolio if first security accounts for 40% of portfolio. Okay. So return on portfolio, which is equal to, so 40% of portfolio, first security. Okay. So in the first security, which is 12%, 0.4 into 12%. Okay. Plus 0.16. 60. So remaining 60% is on second. 0.6 into 16%. Okay. Then 4.8% plus 9.6%. You will get, which is the answer, which is 14.4% is the return of portfolio. If first security accounts for 40% of portfolio. Okay. So the second is ultimately 60%. So if we calculate the net rate, which is 14.4%. So moving to the question 176, if the rate of interest is 12%, what are the doubling periods as per the rule 72 and the rule of 69 respectively? So you must remind that. So rule of 72, which is, and rule of 69. What are those? 72 divided by interest rate and 69 divided by interest rate. So 72 divided by interest rate. What is that? 12%, right? So 12%, which is nothing but 6 years. And 69 divided by 12%, which is 5.75. So approximately the near value which you are getting 5.75. So the nearest value which you are getting is 5.8 and 5.3 years. Option B is the right option. So moving to the question 177. To create a minimum variance portfolio, in what proportion should the two securities be mixed if the following information is given? S1 equal to 10%, S2 equal to 12%, P12 is equal to 0.6. So here, in a two asset portfolio, the minimum variance portfolio weights can be calculated using the formula based on the standard deviations and correlation coefficient. So given here S1 equal to 10%, S2 equal to 12%, P12 is equal to 0.6 with the weights for the minimum variance can be calculated as, like if you use the formula, approximately you will be getting 0.72 for the first security and 0.28 for the second security. The answer will be ultimately 1. So 0.72 is for the first one and 0.28 is for the second one. Okay. So moving to the question 178, a portfolio consisting of two risky securities can be made riskless. That is SP equal to 0 if the securities are perfectly negatively correlated. Okay. So then the SP equal to 0. And CAPM accounts for what risk? Systematic risk. Okay. Moving to the question number 180, assets management company is formed. Asset management company is formed for what? To manage the mutual funds, investments, not for the bank's assets and construct infrastructure projects to run a stock. No, right? To manage mutual funds investment. So prime duty of a merchant banker is working as a capital market intermediary. So these are the theory part questions. 182. Basic objective of a money market mutual fund is what? Investment in short-term securities. Money market mutual funds invest in short-term high-quality debt securities such as treasury bills, commercial papers, and certificates of deposits. So these funds aim to provide liquidity, safety, and a modest return. Okay. So moving to the question 183. Basic objective of a money market mutual fund is what? So usually if you look in India, entry load, which is charge on buying units, right? So which is entry load, is generally not allowed by SEBI. While exit load, which is charge on selling unit, exit load is allowed in certain cases, especially if investors, okay, redeem their investments before a specified period. So, okay, so which of the following? Sorry. Again, I am discussing the wrong question. Which of the following not? 182 we have to discuss, right? So basic objective of a money market mutual fund is, he is asking us some money market mutual fund. Okay. So here the money market mutual funds invest in short-term high-quality debt securities. Already we have discussed it, right? Investment in short-term securities. Sorry, I'm just a bit confused here. Okay. So investment in short-term securities because money market mutual funds invest in short-term high-quality debt securities such as treasury bills, commercial papers, and certificates of deposits. So these funds aim to provide what? Liquidity, right? So 183, which of the following is true for mutual funds in India? As I told you, entry load is nothing but charge on loading units, buying units, sorry. Whereas exit load is the charge on selling units. So under certain cases, which is what? Exit load is allowed, right? So exit load is not allowed, entry load is allowed, entry load is not allowed, exit load allowed in some cases is the right option. So moving to the question 184, which of the following is not available in India? Index options, index futures, commodity options, commodity futures. Which is not available? Commodity options is not available. Which of the following is the benefit of depositories? These are the theory questions. You must have the knowledge. So here the depositories provide multiple benefits, including reducing share transfer time, mitigating the risk, which are associated with the physical share certificates. Okay, and eliminating the stamp duty on the transfer of shares in electronic mode. Okay, so there is nothing but dematerialized form. So reduction in the share transfer time to the buyer, reduce the risk of stolen, fake, forged shares, no stamp duty on. So option D, all of the above is the right option. Moving to the question 186. Credit rating of a debt security is guarantee of repayment, merely opinion, positive suggestion, negative suggestion. Which is the right option here? A credit rating is an assessment or opinion provided by credit rating agency regarding the credit worthiness of a debt security issuer. So, but it is not a guarantee of repayment. Okay, it's a rather an indication of the issuer's ability to meet the debt obligation. So, which is a merely opinion. Okay, moving to the question number 187. The first computerized online stock exchange in India was, which is what? The Counter Exchange of India, which is OTCI, established in 1990, which we have discussed in the theory part. It was the first computerized and screen-based stock exchange in India. Clear? It was created to provide small and medium-sized companies with an exchange for trading. Okay. Moving to the question 188. Which of the following derivative is not traded on Indian stock market? Forward rate agreements. Index option is traded, stock futures, index futures, everything is traded, right? So here the forward rate agreements are not commonly traded on Indian stock exchange. Instead, they are usually traded over the counter, OTC, or are not part of the derivatives available on exchanges like NSE or BSE. So they trade index options, stock futures, and index futures, right? So moving to the question 189. How many depositories are there in India? 2. NSDL and one more thing, CDSL. NSDL is nothing but National Securities Depository Limited. CDSL is nothing but Central Depository Service Limited. Okay. Question number 190. Commercial paper are generally issued at a prices of less than the face value. Correct. Moving to the question 191. Which of the following is not applicable to commercial paper? Face value or issue price or coupon rate or none of the above. So coupon rate is not applicable to the commercial paper. It is not a bond. Okay. Or any debt instrument. Yeah. So dash funds do not have a fixed date of redemption. Dash funds, open-ended funds. Okay. Question 193. In India, Nifty and Sensex are calculated on the basis of what? Free float capitalization, not paid up capital or market capitalization or authorized share capital. Question 194. The type of collateral used for the short-term loan is type of collateral, which is nothing but security. Okay. Stock of goods. So here for short-term loans, lenders often require collateral that can be quickly liquidated. So the stock of goods is a quickly liquidated, right? Such as inventory or stock of goods rather than long-term assets like real estate or machinery. Okay, stock of goods is the right option. So moving to the question 195, which of the following is a liability of a bank? Which is treasury bills, commercial papers, certificate of deposits, junk bonds, or certificate of deposits. Because certificates of deposit, CDs, we usually say, right, represent the deposits made by investors with the bank and their liability for the bank as they must be repaid with interest. Moving to the question 196. Commercial paper is a type of what? Unsecured short-term debt. It's not a secured. Okay. So commercial paper is a unsecured short-term debt instrument used by whom? Corporations to finance accounts payable, inventories, and meet other short-term liabilities. Okay. Moving to the question 197. Still 3 more are left. Okay. For completion of this 200 MCQ series. So which of the following is not a spontaneous source of short-term funds? Which of the following? Trade receipt, trade credit, accrued expenses, or provision for dividend, or all of the above. Wherever there is all of the above, you must be careful. So here the option trade credit and accrued expenses are not a spontaneous source of short-term funds. Okay. So provision for dividend. So trade credit and accrued expenses arises naturally from day-to-day operations. Okay. So whereas provision for dividends or planned obligation are not a source of spontaneous financing. Okay. He's asking us not a spontaneous. So but these both are spontaneous, right? So option D is the C is the right option. Moving to the question 198. In India, commercial papers are issued as per the guidelines issued by commercial papers. So whereas commercial papers, that's all comes under the Reserve Bank of India. Moving to the question 199. Okay, which of the following is a measure of debt service capacity of a firm? Debt service capacity of a firm. Okay, here what are the options here? Current ratio, asset test ratio, interest coverage ratio, debtors ratio. Here the option is interest coverage ratio. It measures a firm's ability to meet its interest obligation, right? So it is nothing but debt service, right? Indicating its capacity to service the debt. Moving to the last question of our 100 MCQ series. Okay, statement of a cash flows are included in which Ind AS? Ind AS 7. Okay, but before the cash flow statement only we have discussed. Ind AS provides the guidance on the preparation of the statement of cash flows. Okay, showing a cash inflows and the outflows are categorized as operating, investing, and financing activities. Okay, so with this, we have finished our 100 MCQ series. Okay, thank you for watching the video.